Tarunji, around 8 participants has joined out of 13.
Okay.
Good morning, sir.
So total 13 participants are there, sir?
Yes.
Okay.
So good morning, all the participants. Today, our
Sir.
first session will be taken by CA Tarun Mahajanji.
Right.
Yeah. Tarunji is by profession chartered accountant since last 20 years, I think 21 years.
21, yes.
And also registered valuers from Indore and has taken classes in ICI RVO and other RVOs as well. ICI RVOs का नाम specifically इसलिए this is the biggest RVO in India and it will be the biggest forever, we can say. Even if it is handling only one asset class, securities class, because of the largest second largest accountancy body in the world. So probably maximum organization also think that only chartered accountant can do valuation, even after the introduction of registered valuation concept, that it is the main foray of the chartered accountants only.
Right.
So before the lunch, complete session will be taken by the Tarunji, and after the lunch, CS Anuradha Gupta. So Tarunji, please try to enroll by audio also.
Sure.
Chatting is allowed, no doubt.
Right.
Yes.
All right. So a very good morning to all of you and welcome to this session. Vijay sir has already given my introduction. So I will just would like to have a very quick short introduction of all of you. I'm not going to waste a huge amount of your time. I just need to know 2 or 3 things about you. That is which professional qualification you have, CACS, CMA, IP, whatever. And how many years of experience you have as a professional. So let's start our talk with Rajesh Jain sir, because in the window he is appearing first. Yes, sir.
Myself Rajesh Jain, and I qualified in 1998 as a chartered accountant.
Okay.
And since then I'm in practice. I'm doing my own practice, having my clients in real estate and other industries as well.
In which city you are situated, sir?
Delhi, New Delhi.
Delhi. Okay, that's great. All right. Sir, I did in 99, so I'm 1 year junior to you.
Oh. Actually, if we talk about our profession, it is not about the year of qualification. It is the exposure you have got in your industry. That is the main.
Yes. That's right, sir. Harsh, sir? You have to unmute yourself, sir. We can't hear you.
Sorry. Good morning, Tarunji.
Good morning.
My name is Harsh Dalal. I'm a chartered accountant. I qualified in 2012 May batch. And since then, I have worked for KPMG and EY in audit practice.
Wow.
And I started my own practice last year in April.
Okay, that's great.
Thank you.
रोहित सर, हम मिले हैं शायद पहले.
You are already my teacher in ICIC group. I did that 50 hours there. Here I'm joining just for knowledge.
Right.
But I've got my certificate.
Yes, because you were one of the most active participants. That's why I can recall you.
Because I have to learn more.
Most welcome, sir. Most welcome.
Thank you.
Right, sir. Lokesh ji.
Morning, Tanuji.
Good morning.
Yeah, I'm a chartered accountant by profession and settled in Faridabad. I have started my own practice in last year.
Okay, and in which year you qualified?
I qualified in May 16.
May 16. So today's session you are going to you will find it to be elementary, right? Because you qualified recently.
Yes.
So SFA must be fresh in your mind still. So that way I'm going to teach some basic concepts of SFM only, you can say that. So today's session, at least for initial 1 hour, you'll find it to be elementary because the topic allotted to me is like that only today. Okay. So I hope, I think you will be giving most of the answers and probably you will be fastest because you are in touch with academics. Right. Preeti ji.
Hi, myself Preeti here. I qualified in 2006. That's 14
Okay.
years. I was in corporate and now in practice. Yeah, that's it about me. I'm from Kerala.
Okay. All right. Great. Great. Nikhar sir.
Sir, good morning.
Good
This is Neghar Jain. I am a chartered accountant. I have qualified in November 2010, and I was your
2010.
yes.
Okay.
I had All India 21st rank,
Wow. That's great.
and नाहटा में पढ़ा हुआ हूँ मैं.
मुझे याद क्यों नहीं आ रहे हैं आप?
सर शक्ल चेंज हो गई मेरी. चेंज हो गई. बाहर फोटो जो लगा हुआ है बहुत पुराना लगा हुआ है.
हाँ वही क्योंकि वहां पे सबके रैंकर्स के फोटो लगे हुए हैं.
हाँ तो वो उसमें बहुत सारे बाल हैं. इसमें अभी जो फोटो है उसमें बाल नहीं है.
प्रोफेशन ने लिख
तो That's why maybe आप नहीं पहचान पा रहे हो.
हाँ
असीम सर से मैं रेगुलर टच में हूँ, तो असीम सर मेरे को अच्छे से जानते हैं.
अच्छा ग्रेट.
हमारी काफी टाइम से बात नहीं हो पाई, तो बड़ी खुशी हो रही है कि दोबारा आपको मैं ज्वाइन कर रहा हूँ.
अरे वाह ग्रेट.
आफ्टर 10 years, ऑलमोस्ट 12 years के बाद आपकी क्लास
हाँ.
अटेंड कर रहा हूँ, तो आई एम सो ग्लेड.
आप
मैं कल से जब से नाम सुना कल से आपका, मैं आई एम वेरी एक्साइटेड.
ओके सो नाइस ऑफ यू. तो आप कहाँ सिचुएटेड हैं?
मैं कोटा हूँ सर, राजस्थान
कोटा
में.
है अभी? अरे वाह ग्रेट.
आई एम प्रैक्टिसिंग.
ओके दैट्स ग्रेट. ग्रेट. वाओ. Jacob sir.
Yeah, I'm a company secretary in practice.
Okay, you're a company secretary in practice. That's great. And like, how many years of experience you have, sir?
Since 2014.
2014.
2004.
Four. Okay. Okay. All right. That's great, sir. That's great. You are in which city, sir?
Pardon?
Which city you are situated?
Bangalore.
Bangalore. Okay, that's great. Lokesh ji, are you with us? Lokesh Mittal, sir.
Yes, sir.
So I hope you are also one of the participants, sir. Lokesh ji.
Basically, I have joined with the two devices.
Acha, you have joined with two. Okay. Acha, okay. sorry. Okay. Ashwin ji.
Morning, sir. This is Ashwin from Chennai. I'm a practicing chartered accountant. I have been practicing for the past 1 decade.
Okay, that's great. All right, sir. So with this short introduction, I'm Tarun Mahajan. I told you I will also give you my quick introduction. Just give me 1 minute. And then, because we don't have much time, we have around 4 hours of time. So, in 1 or 2 sessions, what I did, I came and I started delivering the session. And then somebody said that, at least some warm-up exercise must be there and you should not directly start delivering the session. So that's why I started doing this. Right. So here I am. Okay, I have shared this. Great. So I'm Tarun Mahajan. I am a chartered accountant, qualified in 99. Then I did DISA also. I just have this certification. If you ask even D, what is D of DISA? I forgot everything now because it is almost 16 years back I did it. Then I did CFA also in year 2008. At that time, this international CFA course was not very popular in India. When I did, there were only 379 CFA charter holders were there in India. Now this course has also gained popularity. Then last year in January itself, I qualified this valuation examination, and with God's grace, I could do it in first attempt with 80% marks. And I am more an academician, less a practitioner. So I have been guiding CA, CS, CFA students since last 21 years and taught more than 40,000 students in face-to-face classes. And as far as this 50 hours of training is concerned, so I am there with ICAI, ICSI, ICMAI, and some more RVOs. And I have taken more than, I can say, 25 such sessions and guided more than 2,000 professionals in this 50 hours training of valuation course. I am involved in some athletic activities also, like running a marathon, doing long distance cycling or long distance swimming. And based on my marathon experience, I have written a motivational book also titled as My Marathon. So my contact number is here. Even after the session, if you have any doubt, just feel free to connect to me. You can note it down. It is 98930-40600. Probability is there in the PDF file also, which I shared yesterday on the WhatsApp group. And my email ID is tarunmahajanca@gmail.com. And my LinkedIn profile is also there. So even after this 50 hours training is over, or even after, till the date you appear in the examination, just feel free to ask me any doubts related to any part of the finance. Like I have been in this batch, I am taking just 4 hours of session. In last batch, I took 24 hours of session out of 50 hours of total training. So it's not like that you can ask me doubts only related to what I am delivering today. Anything which is related to finance in this course of valuation, if any doubt arises in future, feel free to connect to me on WhatsApp. That will be the best mode of communication. And once you become a registered valuer, and definitely you will become soon. Even after that, if you are handling any practical assignments, I am practicing valuation since last 1.5 years. And finance is my core area, so I'm enjoying it. If you have any practical issue also, once you become a valuer, just feel free to connect to me for solving those issues. All right, sir. So now let's start our course study. So as Vijayji has already said, as the managing director of this RVO, he expects everybody to participate by voice as well as by chat, and try to keep your videos on full time, as he is saying in the chat also. All right, sir. So here we go. We are not going to study something really deep into the finance. We have, in most of the valuation courses, we have mixed audience. So those who have recently qualified, they find it to be very simple, this part of the finance, or those who are already practicing valuation, they find it to be very easy. But those who are from non-finance background, like practicing company secretaries for many years, they may find this part to be interesting and maybe a little difficult also. So I try to cover both hands. On one hand, I'll try to satisfy those people who do not have a finance background. And on the other hand, no. On the other hand, case study part is there where you can touch the height of the concept. But today I have not been allotted that. So I'll not be touching, but definitely some other faculty will be doing that part. All right, sir. You already know the examination pattern probably. This is 80 MCQs of 1 mark each is there. And then remaining 20 marks are from case studies. So there are 10 MCQs multiplied by 2 marks, that is 20 marks. You'll be facing 3 case studies. 25% negative marking is there. So guys, you must have gone through one concept in one of the previous sessions, and that is valuation approaches. When I talk about valuation approaches, there are 3 approaches, right? Well, can you name those 3 approaches? By voice, by chat, whatever method it is.
Income, cost, and market.
Right. Income approach, cost approach, and market approach. That's perfectly correct. Yes, everybody. Right. So, what I think is, what India says is a different issue, but what I personally think is that the most core method, or the most important method is income method actually. Income approach, better I say. Market approach is nothing but copying the hard work of somebody who has used income approach. I do all the hard work to make valuation of my company as per income approach. And then you copy my valuation, and that when you copy my valuation, it becomes market approach. And cost approach is when everything fails, especially in case of a company in financial distress or company which is moving towards liquidation. In that case, the cost approach appears to be best. Usually, cost approach is not used for going concerns. So we will be focusing here on income approach. I'll be telling you how to calculate cash flows for income approach and then how to calculate discounting rate. You know, what is value today? Value is sum of future benefits. Now, this is universal truth. Whether you are making valuation of equity share, preference share, debenture, any security or any financial asset, or you are making valuation of land, building, plant, machinery, anything in this world. Even if you want to make valuation of a human, you want to make valuation of Tarun Mahajan, or even if you want to make valuation of a cattle, say you want to make valuation of a cow, in that case also, this is the truth. Value is sum of future benefits. If I can give you any future benefit, I am valuable. If I cannot give you any future benefit, then from your perspective, I don't have any value. That's the hard truth. Say you want to make valuation of a cow. So what future cash flow? When I say benefit, benefit should be in terms of cash flows. When you want to make valuation of a cow, what future benefits you will have? You will be selling, milk, or maybe even the cow dung, or even cow urine also. And the cow may produce a calf, and then later you can sell it out. So by considering all these cash flows, you can make valuation of a cow.
Sir, I have a doubt. You said it is the present value of all future benefits, right? So
Yeah.
future benefits can be both negative and positive, right?
Exactly. Perfect. Very nice. Very nice. It can be negative also. So say I'm having the cow and I'll have to feed the cow. So that's the negative outflow, negative cash flow, outflow. And by selling the milk, I'm getting positive inflow. I'll have to make net of it.
Okay.
Right, sir. Perfect. When you're making valuation of business as a whole, you need to make capital expenditure timely from time to time. You need to increase your exposure in working capital. So that is outflow, and that should be considered as an outflow while making valuation. So yes, exactly. Benefit means net benefit. So here is the better definition. To be precise, it is sum of present value of all future net cash flows. So, but here you need to keep in mind, you will have to calculate present value. If I say make sum total of 5,000 rupees receivable at the end of first year, and 5,000 at second year, and 5,000 at third year, and if you answer this to be 15,000, that will be a wrong answer, because here the unit of measurement is not same. If I tell you make sum total of three figures, 100 liters, 100 kilometers, 100 kilogram, we cannot make a sum total because unit of measurement is not same. Similarly, 5,000, 5,000, 5,000, first year, second year, third year, we cannot make a sum total because again, the unit of measurement is not same. So first we need to bring it to the same level, that is 0 year. And that is how we calculate, that is why we calculate present value. So, in CA intermediate level or even in CS executive level, there is a chapter named as time value of money. And that gives us a formula. Future value of money is equal to present value of money multiplied by 1 plus r raised to the power n. Future value is equal to present value into 1 plus r to the power n. Or acronyms are like this: FV is equal to PV into 1 plus r to the power n. But I am interested in calculation of present value, so I shuffle the formula and it becomes present value is equal to future value divided by 1 plus r to the power n. This is the formula for compound interest. If someone tell me that use simple interest, then formula will change accordingly. The formula with simple interest will be Future value is equal to present value into 1 plus R into N. This is just interest on principal, and here it is interest on interest also. We don't use simple interest for calculation of future value or present value. So just keep in mind this basic formula. Present value is equal to the future amount divided by 1 plus discounting rate or the desired rate of return of the investor. Sir, what is R? R is desired rate of return of the investor, which is also named as discounting rate. You know why discounting rate? Because this rate is in denominator. When you calculate present value, amount actually reduces. That is, cash flows are discounted, and that's why the rate is named as discounting rate. So what is value? It is sum of future benefits. Let's do one quick simple question on this. To some extent, we will be using MS Excel also. So meanwhile, I just request you to open one Excel file also on your laptop, and you can resize the zoom window so that it covers just half of your screen, and remaining half for the Excel sheet. Right. So here I go. Look, it says a bond is expected to give rupees 5,000, 6,000, 7,000 and 8,000 from year 1 to 4. It's kind of exotic bond. It's not a regular bond which pays coupon and then it gives you the redemption price. It is giving you lump sum 5,000, 6,000, 7,000, 8,000 inclusive of principal and interest. And you have to make valuation of this bond. Looking at the poor credit rating, the bond is commanding a BBB minus credit rating. And looking at that poor credit rating, your expectation of return from the bond is 10% per annum. So now you have to calculate present value of these 4 cash flows, make a sum total, and then interpret the result. We will do the calculation, sir. But let me tell you, imagine these cash flows at S time step. So first year is first step. At first step, there is 5,000 rupees. Second step, 6,000. Third step, 7,000. Fourth step, 8,000. And then I'll calculate present value. It means I'll bring it down from year 4 to year 0 and 3 to 0 and 2 to 0 and also 1 to 0. So present value of this 5,000 rupees at the rate of 10% is 4545. 6,000 has present value of 4959. 7,000 has present value of 5259. 8,000 has present value of 5464. And then make a sum total of all these 4 items. So which becomes actually 20227. 20227, 20,227. That is year 0's fair value of this bond. You know, here I can make a sum total because now all cash flows are on same ground. I cannot make a sum total of 5,000, 6,000, 7,000, 8,000, but I can make sum total of their present values. So fair value of this bond today should be 20227. So sir, you are going to become a valuer and somebody asks you what is value, and a very precise answer is sum of future benefits. Future benefits were 5, 6, 7, 8,000. You calculated present value, make a total, and you get fair value equal to 20227. Let's do it on Excel. So I'll just share on screen my Excel file. You can simultaneously open your own Excel file Now let's make a table like this. Here 1, 2, 3, 4. The amount is 5, 6, 7, 8,000. And then I will calculate present value at the rate of 10%. Just create a table like this and make sure that you also start the table from the same row and column where I have started, so that later it will be easy to reconcile answer. Okay, so now you can recall that what is the formula for present value. So present value is equal to future value divided by 1 plus r raised to the power n. This is the formula, right? But we need not to apply the formula. There are inbuilt functions in Excel. So the PDF I have shared, if you can keep it open in a third window, you can see that I have given several function names. Like in Excel, PV stands for present value, FV for future value, and PER is for number of periods. Rate is desired rate of return of investors. Mind it, this is not the rate to be paid by the company. This is the desired rate of return of the investor. That is how much return he wants to earn, that we have to consider over here. Right? And then there is one thing which is named as PMT. We are not going to use it, but I will quickly define it. It is amount of one installment in case of annuity. It's amount of one installment in case of annuity. Annuity means a series where you get equal amount each year. First year 1,000, second year 1,000 rupees, third year 1,000 rupees, fourth year 1,000 rupees, and so on. So annuity is a series of amounts where all amounts are equal and all time gaps are equal. That is actually annuity. And in that case, this 1,000 rupees will be PMT, amount of one installment. So let's use present value function over here.
Sir, I have a doubt.
Yes, please.
Is the desired rate of interest, desired rate of return, is it post-tax or pre-tax?
It is post-corporate tax, but pre-personal tax.
Okay.
So whatever corporate tax is there, that has to be incorporated in calculation of this rate that we will learn in calculation of weighted average cost of capital. But as an investor, my personal income tax, I will not consider over here.
Okay.
Right, sir? Okay. So here I'll calculate equal to PV bracket open. See, as soon all functions in Excel starts with equal to sign. So equal to PV bracket open. When I open this bracket, Excel starts giving me tool tip. If you wish, I can zoom it for you for a while. Just a minute. So is it zoomed at your screen also, or can you see the zoomed screen now? I hope yes. So equal to PV bracket open. As soon as I do it, the beautiful thing is Excel offers tool tip that you need not to memorize the function of Excel. First, it is asking to input discounting rate, which is 10%. Beware, you should not put here 10. Either you write, if you write 10, Excel will consider it as 1000%. So either you should write 0.10 or you should write 10%. Okay. Then number of periods. Here I give the cell reference. I click at year 1. So cell reference taken by Excel is A3. Notice that as soon as I, notice here, first of all, this rate is written in bold letters in the tooltip. Then I put a comma, and once I put a comma, then NPER is in bold letter. So now I have to input number of periods. And then I put a comma again. And now PMT is in bold letter. But this is not the case of annuity where all installments are equal. So there is no PMT in this question. To skip PMT, I'll put another comma. And notice here in the tooltip, as soon as I put another comma, now FV is in bold letters. If I click this, 5,000. Now this type is related to PMT. And as I have skipped PMT, so I will not input anything for type also. I'll simply close this bracket. Look at it carefully. Do it simultaneously. Press enter and you'll get this answer. Just a minute. I'll just do one thing. Now I will copy it down somewhere else. Right, sir. So this is how you calculate present value in Excel. I hope everybody got it and you don't have any confusion. But now you might be thinking that why this minus sign is there. Look, Excel formula is designed in a way, it thinks like this, that if you want to receive 5,000 rupees at the end of first year, then today at 0 year, you will have to pay 4545. If you want to receive 5,000 rupees at the end of first year, then today you will have to pay 4,545 rupees. So that's why this minus sign is there. If you don't like to see this minus sign with red color, you can do one thing. At the place of FV, I have given a cell reference of B3. So instead of B3, put a minus sign, minus B3. So if input is negative, output will be positive. Press enter and see it's here. Some of you might be getting a dollar or pound sign. So that really depends on the Windows regional setting. Don't worry, even if it is a dollar sign or pound sign, that's perfectly fine. Now I would like to copy this formula. So I'll simply do one thing. Just look here. This cell is selected 4545. And at the bottom right corner of this cell, you will find that this one little green color square is there, which is actually named as drag handle. So you double click. As soon as you put the cursor at drag handle, this white cursor becomes black cursor. And then you double click it. So it will be copied in all relevant cells. Once you do this, yes, sir. Okay. Once you do this, thereafter, you need to just make the sum total. The short key for sum total is alter and equal to. You just press alt equal to together and you'll get the sum total 20227. Okay, fine. I hope everybody got this answer. Any problem to anybody in this calculation? No? Fine, let's move ahead. But there is a shortcut to calculate this, and that shortcut is actually NPV, net present value. You know, in financial management subject, net present value has a different meaning. So, you know, in financial management, net present value means present value of inflows minus present value of outflows, right, Lokeshji? Is it?
Right.
Thank you. So, but in Excel, when you say NPV, it assumes it is simply present value. It is the sum of present value of cash flows from year 1 onward. So I'll use here NPV function. And as soon as I type this equal to NPV bracket open, first of all, Excel is asking me to input rate. So I'll say it is 10%. Then as soon as I put a comma, value 1 is in bold letters. So value 1 is in bold letter. It means first year's amount. I type 5,000. Then I put a comma. Value 2 is in bold letters. See in the tooltip, just below the cell where I am working. So I'll type 6,000, comma, value 3 is bold. 7,000, comma, value 4 is in bold letters. Then you can input value 5, 6 also, but I'll simply close this bracket, press enter, and directly get the answer. In fact, instead of typing all these values, I can simply select this range, 10%, and then I put a comma, and then I move the mouse and select this range and press enter, and I'm getting again same answer. So now this is the shorter way of calculating sum of present value of all future cash flows. And here you need not to put a minus sign. Positive input gives you positive output. But beware about one thing over here. Say I delete this 6,000 because at second year there is no cash flow. Suppose at second year there is no cash flow, so I delete this 6,000. Now PV formula is giving me 15,268 and NPV formula is giving me answer equal to 16,341. Can somebody answer this? Why is it happening?
Because in NPV it assumes that year 2 0 is not taken in NPV.
Right. In year 2 there is no amount, so NPV is assuming, NPV is assuming that first year's amount is 5,000 and second year's amount is 7,000 and third year's amount is 8,000 and then full stop. So if you want to get rid of this error, then put a 0 over here and then NPV will not skip this cell and you'll get the same answer both way. Now NPV is saying first year it is 5,000, second year it is 0 and third year it is 7,000. Right? So let's put here 6,000 again. So fair value of this bond is 20227. What is value today for any item in this world? Want to make valuation? Estimate life, estimate cash flow over life, make sum total of all, estimate cash flows, calculate present value of those cash flows, make a sum total of all present values. And that way you'll get current fair value. Life, cash flow, present value, total, current fair value. So current fair value for this bond is 20227. What if it is available in the market at rupees 19,000? What do you say?
It is available at a discount price.
Okay. So would you like to take some action that if it is available at discount price?
We can buy this one.
Yes. Ikarji and Harshji is saying. Amit sir and Subhuji, probably you joined late, so we don't have an introduction. But anyways, you can answer, sir. Lokesh ji, what do you say? If it is available for 19,000, how will you react? I mean, would you like to buy it or sell it or take no action? So definitely we will like to buy it, because if it is something having fair value of 20227 is available for just 19,000, then it is advisable to buy that. Okay, let me ask you one more quick question. If this security, if this investment opportunity is available for 19,000, right? And you buy it for 19,000, then what will be your rate of return on this security? Is it going to be 10% or more than 10% or less than 10%?
More than 10%.
Okay. Nikarji is saying more than 10%. What do other people say? By voice, by text, whatever you prefer, but please answer. And if you're not getting, you need to type or say pass at least. Okay. So Rohit ji is also saying more than 10%. Lokesh ji is saying more than 10%. All right. Subbu sir, you are a chartered accountant, company secretary.
I'm chartered accountant.
And which year you qualified?
2014.
Okay, okay. That's great. All right. So it's more than 10%. And in fact, we can quickly calculate it. So I put here minus 19,000. Why minus sign, you know? Because I'll have to pay 19,000. And how much return I will realize, I can calculate internal rate of return, IRR, that is named as. And there is inbuilt formula. Those who cleared CA in last 5-10 years, they can recall that how cumbersome was this IRR concept. You need to make trial and error. You know, you keep on trying this rate, that rate, this rate, that rate. And then you do the interpolation. There was one formula for interpolation, and that was quite lengthy because, you know, Excel was not allowed in CA examination, but it is very much allowed in valuation examination. So there you can simply do equal to IRR bracket open and select this whole range. And then it also asks us to input guess. Where should I start trial and error? I will not tell you any guess figure. You are Excel. You do it yourself. I close the bracket. I press enter. And I can put it up to 2 decimal points. So the answer here is 12.72%. This is how much I will realize as my rate of return. See? Life has gone easy if you are using MS Excel. In examination, CA examination, it was tough. But here, it will be comparatively easy. So what difference do you notice between these two formulas, NPV and IRR?
NPV is something in rupees terms, and IRR is rate of return, which is getting throughout the period of project.
Right, exactly. So NPV is in absolute terms and IRR is in relative terms. And if you look at the Excel formula, you will find that, you know, NPV is considering the first cell you give as an input. NPV consider it as first year. But in IRR, the first cell you select is considered as 0 year. Just look at, I'm sorry. Just look here. In NPV, see, look here, 1 to 4, this 5,000 to 8,000 I have selected, and NPV is considering first cell is first year. NPV is not reading this. NPV automatically it is considering first cell is first year. But in IRR, first cell is assumed to be 0 year. But be careful, you need to change the sign. If I delete the sign from over here, then you will see that there is a problem. You will see number error. So that's why you need to put a minus sign, and then only you will be able to calculate this. This IRR function can be used in bond management chapter also to calculate yield to maturity. That will be dealt with by some other faculty. But yes, you can calculate it this way. Rohit sir is saying in NPV, the assumption is that the investment is made at the beginning of the year. No, not exactly, sir. NPV is assuming, NPV formula of Excel is assuming that first cell is first year. IRR formula of Excel is assuming that first cell is 0 year. And there must be a sign change, that is initial outflow and then series of inflow or vice versa. All right, sir. So this is how we make valuation. Now, tell me one thing. What if the investor starts expecting 12% return in place of 10% return? What will happen to fair value in that case? If investors start expecting 12% per annum return in place of 10%. What will happen to 20227 figure?
It will
It will
reduce.
become equal to 19,000. It should more or less equal to the 19,000.
Fair value will
IRR
reduce. Okay. Harsh sir and Preeti ma'am are saying that fair value will reduce. Okay. It will come below 20227, right? What do other people say? Yes, actually it will reduce. We can quickly do this experiment. Na? Like in NPV function, simply instead of 10%, you put here 12%. And see, instead of 20,000, the answer is 19,340. I hope you have also made the table like I have done. Just simply do one thing, put 12% and you'll get this answer. You know why this is happening? Because this is the formula for calculation of present value. It is future value divided by 1 plus r raised to the power n. So rate is in denominator. If rate rises, present value reduces. Higher the, one more thing I'll tell you. There is one beautiful concept which is like this. Value is equal to performance divided by expectation. Here, performance means performance of company. That is the debenture. And expectation means expectation of investors. So if investors start expecting more, the value will come down. If company starts performing more, the value will go up, and vice versa. Right? Okay, great. So let's solve one more question on this, and you will do. Okay, quickly allow me to quickly give you one example. Calculate fair value of a ₹1,000 par value bond. Maturity is 5 years. Coupon is 10%. And desired return of investor is 12%. Make a 5 years table and solve this question. And start your table from A24 cell. So that later it will be easy to reconcile.
3104.
No, the answer should be 1000 plus minus something.
Oh.
So answer must be between 900 and 1100. So in this bond, first of all, we need to estimate, there are 4 steps of valuation. One is to estimate life. So here the life is quite simple. It is given in the question itself, that is 5 years. Then estimate cash flows over life. Now coupon rate is 10%. So I'll be receiving 100 rupees each year. To copy it down, I can simply do Control D. Select this, do Control D, it will be copied down. And then thereafter, the next thing I will do is, I'll put here 100 for coupon and 1000 for redemption price. So that way I'll be receiving total 1100 rupees at the end of 5th year, right? And now I have to calculate present value of all these cash flows at the rate of 12%. Okay, without solving this, can you tell me that the fair value of this bond should be at par, premium, or discount?
It is on premium.
Okay, that's Nikharji is saying. What do other people say? The value of this bond should be at par, premium, or discount.
At a discount, 927.90.
Okay. See, company is performing 10%. Investors are expecting 12%. This is the hint I am giving you. Value is equal to performance divided by expectation, right? So company is performing 10, investors are expecting 12.
Discount.
Harsh sir is saying discount. Amit ji is saying premium. Subbu sir is also saying discount. Priti ji is saying discount. Lokesh ji is also saying discount. Majority is saying discount. So let's go like a democracy. The right answer is discount. Otherwise also it's discount because performance is less and expectation is more. Here if I calculate present value equal to PV bracket open, I expect you to do it both ways with PV as well as with NPV formula. If I want to copy it down, I'll select it and do Control D and it will be copied down and alter equal to and it will make a sum total. But if I'm using NPV formula directly, then I'll be doing equal to NPV bracket open 12% comma and this range of cash flows and enter. So with NPV formula also it is 927. Now I just request everybody to solve and confirm the answer both ways with PV function as well as with NPV function. As soon as you get the answer, just post the answer in chat window or speak it out so that I'll be aware that yes, you have done it. Probably Rohit sir has also joined us. Rohit Bajaj sir. Sir, are you there with us?
Yes, sir.
Okay. Can I have just your quick introduction, like your
Yeah.
CACS or what, or how many years of experience?
So I'm CA from Hyderabad into practice from past 5 years.
Okay, that's great. And right, great. So we are going through just some basic things only. So you have not missed something really great. But yes, you need to join us now and do calculations with us. Okay. Everybody's got the answer. Fantastic. Now let's move for the next. Let's recall that value is sum of future benefits. So now we have this next question. Question number 2. Calculate fair value of rupees 1000 face value perpetual bond. If coupon is rupees 90 per annum, that is 9% coupon rate, and desired rate of return of investor is 10%. Okay. So Rohit ji is saying it is 900 is the fair value. What do other people say? You know, if I try to create a table, I'll have to make the table for infinite years. So that will be very lengthy to solve. Even with Excel, it will require some hard work to be done. So thank God that there is one ready-made formula, and the formula says, you know, this is a perpetuity. What is annuity? Where if all amounts are equal, all time gaps are equal, and limited time period is there, it is annuity. What is perpetuity? Perpetuity means equal time gap, equal amount, and forever, for infinite years. So present value of perpetuity is equal to amount of one installment divided by the rate of interest, that is A divided by R. So amount of one installment here is 90 rupees because you're getting 90 rupees interest every year, and divided by desired rate of return of the investor is 10%. So the answer here is 900 rupees. Okay, do we have perpetual bonds in real life? Yes or no? Or it is just a theoretical concept?
No.
Okay, that's one answer.
बिकॉज अभी जितने भी बॉन्ड इशू हो रहे हैं, जैसे पीएनबी का अभी एक बॉन्ड है, वो मतलब 5 या 10 साल के लिए ही होते हैं मैक्सिमम.
Right. Okay. What do other people say? So wrong answers are acceptable. There is no negative marking here. Or you can say at least pass, but you need to participate. Okay, yeah, no idea is acceptable. Perfect. Pass and no idea are very much acceptable. Okay, so let me tell you, you know, if you read Companies Act says, debenture rule says, better I say, issue of debenture rules, that a company can issue debentures maximum for a maturity of 10 years. 10 years only. But if it is for infrastructure funding, etc., it may be up to 30 years. But at the same time, Section 1 of the Companies Act says that this act is applicable to a banking company subject to Banking Regulation Act 1949. And the same thing is there for electricity company, insurance company, and special act company also. Now, Banking Regulation Act 1949, it allows banks to issue perpetual debentures. So legally it is allowed. And some of the banks, at least 8 or 10 such banks, have issued perpetual bonds also. Yes Bank has issued perpetual bond. State Bank of India has issued perpetual bond. HDFC Bank has issued perpetual bond. So 8 or 10 such issues are there. But mostly these bonds are with call options, callable bond that you will study under fixed income securities. That's a different chapter. But let me tell you, yes, it exists, but it is rare. Those are quite a few in number. Most of the bonds we see around are redeemable in nature. Okay, so this value of this perpetual bond, why the value of the bond is at discount? Any answer on this? Why the fair value is at discount? Why not it is at premium? Why not it is at par?
The expectations are higher.
Okay, that's the answer by Rohit sir.
Your coupon rate is only 9%, whereas your expected rate of return is 10%.
Okay, fine, fine. 2 answers, 3 answers we have, 4 in fact. Preeti ji, what do you say, Amit sir? You can say pass also, but you need to say. See, the reason is correct. Performance and expectation. Company is performing 9%. Investors are expecting 10%. So whenever investors expect more, not investor, anywhere in your life, this is such a universal concept. So say this is not a COVID-19 situation and you go to a restaurant and you order the food and you expect that your order should be ready and served at your table in next 15 minutes. And they serve it in 40 minutes. Then their performance is less than what you were expecting and their value will come down and you will say what a poor service this is. Wherever the expectations are more than performance, the value is lower. So same thing is here happening here also. Somebody can doubt also, okay, you know, this formula can be used for valuation of equity shares also. If an equity share is expected to give constant dividend forever, if any equity share is expected to give constant dividend forever, in that situation, one can use this formula for valuation of equity share also. Let's say equity share is expected to give 90 rupees dividend each year forever. 10% is the cost of equity. In that case, fair value of equity share will be 900 rupees. But somebody can doubt that why should I believe that this formula for present value of perpetuity is correct? You give me a formula and you ask me to believe that this is correct. Why should at all I believe in this formula? You know, if you don't believe in this formula, then I'll have to make a table and discount all cash flows. And then I will not be using the formula. But I'll have to make table for infinite years. While in Excel, we have only 1 million rows. 10 lakh rows are there. But don't worry, I won't have to make it up to infinite years. I'll have to make it up to just a long period of time, 100, 200, 140, 150 years. That's it. You don't do it with me, just observe carefully. I am planning to make a table for 150 years, say. So there is one fill function, fill series, column 150. See, filled up. That's the beauty of Excel. It saves a lot of your time. And this 90 rupees, I'll do nothing. I'll double click it. As the adjusting column is filled up to 150, this 90 will also be filled up to 150. See, 90 rupees up to 150 years. And then present value formula as usual, equal to present value, rate of discounting is 10%. Number of period is a cell reference, amount is a cell reference. 81 rupees is the present value of 90 rupees. I double click it and see, first 90 has a present value of 81. But 14th year, it is 23. 27th year, just 6 rupees is the present value. 53rd year, 90 rupees become just 58 paisa. 79th year, 90 rupees becomes 5 paisa. And up to 2 decimal points if I'm talking, in 103 years, 90 rupees has a present value of 0. So if somebody promises to give you 90 rupees after 103 years, its current value is 0. And that's why you need not to make a table up to infinite. Even a long table is enough. Alter equal to, make a sum total and see. This is the present value. If you don't want to use the formula, use this one. And you will have a great experience that yes, the formula is correct. Now you can have a faith in the formula that yes, the formula is correct. Right, sir? Okay. And just feel free to ask anything you feel like asking. You know, usually when I take this batch for a long period, say out of 50 hours, I take for 24 hours, we get to know each other in one day, and then I know what you are thinking and I modify my style accordingly. But within a short span of 4 hours, I'll not get to know what do you want to ask. So my humble request to everybody is keep asking. Don't hesitate that somebody will think that this is a stupid question, or even if a very high level question is your mind, ask it. Just be participative. Okay. So now fair value calculation, right? Value is equal to C. Value is equal to performance of company divided by expectation of investor. If company gives higher performance, it will command higher value in market. If investors expect higher return, the value will become actually lower. Question number 3. Calculate current.
I have a doubt.
Yes,
it is not related to what we are discussing right now, but generally, so when you do a valuation and you get all the figures from your client, like for instance, in the first example, you said year 1 is 5,000, year 2 is 6,000. So how do you validate those amounts?
Yes, that's a very nice question, Harsha. So the first of all, it is the duty of the client to give you the forecasted financial statements, say for next 5 years, 4 years, 6 years. It is not your duty to prepare those forecasts. Even if you are preparing the forecast, it is the duty of the client to give you the input for his business. But at the same time, it is the duty of the valuer to validate or to do a hygiene check for the data which has been provided by the client. Because otherwise the client will be in the driving seat. If he want to have a higher fair value, he will give you higher projections. And if he wants to have a lower fair value due to any reasons, then he will give you lower projections. So what do you do in that case? If it is a running entity, you also ask for past 3-4 years financial statement. And first of all, when you start valuation assignment, in Excel, first of all, you feed data for last 4-5 years. And then you do the trend analysis and ratio analysis on that data. And accordingly, you try to validate the future projection. This is one way of doing it. And if there is some extraordinary figure they are showing that our sales will be doubled, then you can ask them that how it will be doubled. You're already working for last 5 years, 10 years, and it never doubled. So what is going to happen so it will double? If they can give a justifiable answer, that's right. The challenge appears in case of a startup because they don't have any history. And in that case, you need to rely on their data. But there you can make a comparison with similar startups. If the idea is totally innovative, never done before, then that will be different methods for startup valuation are used, not this discounted cash flow approach is used. But if similar startups have been there in the ecosystem, then you can look at those startups, their data, and then you can say that this is how it is going to happen. Yes, but you have asked a very good question, sir, that yes, we need to validate the data provided by client. Okay, so face value of equity share is 10 rupees. Dividend expected at the end of first year, mind it, dividend expected at the end of first year. Have you noticed that I have not considered 0 years cash flow in any calculation? I'm starting my calculations with first year's cash flow. I am not including 0 year. I am also not including past year's cash flows. So, okay, past years, forget about it. But I am not including 0 years cash flow also. Why is it so? Suppose a company has issued debenture for 10 years and 3 years have already elapsed and 7 years are yet to go. So what should I consider? Remaining 7 coupons I should consider for valuation of bond, or past 3 coupons which are already paid, should I consider that? 2 already paid. See, I'll explain you the whole situation again. A company has issued 10 years bond. First year end coupon has been paid. Second year end coupon has already been paid. You are standing at the end of third year, and here at the end of third year, today, right at this point of time, company is paying coupon. So that is 0 years cash flow now. And next 7 coupons will also be there. So 2 interests have already been paid. 7 interest will be paid. 1 interest is paid now. What should I consider? Past 2, present 1, or future 7, or all 3?
Value of future benefits, like you mentioned, fair value is always for future benefits.
Okay. So that's what I said, but what do you feel about it? Rohit Bajaj sir is saying remaining cash flows. Thank you for participating, sir. Jacob sir, Surendra sir, Rajesh ji.
Value of future benefits, yes, but then if I'm getting money now, I should consider year zero cash inflow as well, right?
Okay, okay. Okay, let me ask it one by one. Should I consider future cash flows, yes or no? First of all, we'll consider 3 questions. What do you say about remaining 7 coupons? I should consider or ignore those remaining 7 coupons? Okay, looks like we are unanimous for this, that yes, we should consider this. Now, let me ask you, should I consider the past 2 coupons which have already been paid by the company? There are 2, no, 3, 4, 5. Okay, so you're unanimous for that also. Now, the problem is about 0 year. Should I consider 0 years coupon also in my valuation? Yes, no, or any other answer would you like to give besides yes, no? Okay, we have 2 yes. Okay, that's very nice insight, Priti ji. Okay. So looks like majority is saying yes. That really depends now on the cutoff date. So, there is concept of X date and cum date. If I'm buying it on X date, yes. If I'm buying it on X date, that is, now I'm buying it, so I will not, company has started paying coupon, but now I will not receive it. It will be given to the previous owner. In that case, I don't have a claim on it. Suppose I want to buy hen, murgi khareedna hai mujhe ek. And right at the point when the deal is going on, the hen produces 1 egg. So whose claim it is? It is the previous owner's claim, because the ownership, risk and rewards are not yet transferred. So before the risk and rewards are transferred, if anything is given, that belongs to previous owner, and that's why I will not consider it as an inflow of cash. But if I am expecting that, you know, I'm not standing exactly at the end of third year. I'm standing 10 days before at the end of third year. So after 10 days, third year's coupon will be paid, and I will complete this transfer process within 2 days only. Now, so the day I buy debenture, after 8 days, that is almost 0 year it is, company will pay coupon and I will have a claim on that cash flow. And that's why I need to consider it as an inflow of cash. So what is important is you need to have a claim on cash flow. If you have a claim on cash flow, then you will consider it. If you don't have a claim on cash flow, you will ignore it. It is simple. So in most of the questions, until and unless question specifically mentions, we assume 0 years cash flow. We not assumes, we ignore 0 years cash flow. Unless otherwise stated, we ignore 0 years cash flow and we start cash flow consideration from first year. So first year dividend is 4 rupees, growth in dividend forever. Now, as compared to question 2, question 3 is different. In question 2, 90 rupees was constant every year. Here, the 4 rupees amount is not constant. It will grow forever. And you know, this situation is actually named as growing perpetuity. This was the constant perpetuity, but now we have a situation of growing perpetuity. Dividend is not constant, but growth in dividend is expected to be constant at 10% forever. Expectation of equity shareholders is going to be 20%. This is the discounting rate. Okay, before I proceed, let me ask you one question. So, should I continue in English only, or should I use mixed language like some Hindi and some English? You know, I just want to know your comfort zone. Okay. All right. Great. So expectation of equity shareholders is 20% per annum. Now, how do I solve it? So now I will not be using present value of perpetuity formula. Now I will use present value of growing perpetuity formula. That formula was given by Mr. Gordon, hence it is named as Gordon's model. And the formula runs like this. Present value of growing perpetuity is equal to P0 is equal to A1 upon R minus G. P0 is equal to A1 upon R minus G. Look here, the formula for perpetuity was A upon R. Here also the formula is A upon R. Here also the formula is A upon R. But in the denominator, we are deducting growth rate. That's one difference. And other difference is I'm not putting A, I'm putting A1. You know, in perpetuity, first year it is A, second year it is A, third year it is A, fourth year it is A. But in growing perpetuity, first year it is A1, second year it is A2, third year it is A3, fourth year it is A4, and so on. It keeps on increasing. So first year's amount here is 4 rupees divided by the discounting rate. Desired rate of return of investor is 20%. And the growth rate is actually 10%. So current fair value of equity share is 40 rupees. Just have a look carefully. And keep in mind that if in any question A1 is not given, then you will have to calculate it like this. A1 is equal to A0 into 1 plus G. So current dividend is given as, say, 50 rupees and growth rate is suppose 10%. So first year's dividend will become 55 rupees. Keep in mind In this formula, if you put A1, you get value at the beginning of first year, that is end of 0 year, P0. But if I put here A5, then I'll get P4. If I put here A8, then I'll get P7. So if I'm starting from 8th year's cash flow, I'll get value at the beginning of 8th year. And beginning of 8th year is same as end of 7th year. Beginning of 8th year is same as end of 7th year. So this is interesting. Just keep it in mind and you will have to use it somewhere. I am not taking that part, but yes, the next faculty will be using it in case study part. Okay. So just solve one question on you now. This is the example. Current dividend is ₹5 per share. Growth rate is 6% per annum. Equity shareholders are expecting a return of 15% per annum. What is current fair value? Calculate and then speak out your answer. Also post it in the chat box.
The face value remains at ₹10?
Yes, face value remains at ₹10. But let me tell you, it will not affect your valuation. Even if I say it is ₹5 or ₹20, valuation will remain same.
No, but if the dividend is 5%, that is 50. If it is face value, then it is 50% dividend rate.
Dividend is given in terms of amount, sir. ₹5 per share, irrespective of face value. If it would have been given the dividend rate is 50%, then face value plays a role. Suppose question says that dividend rate is 50%, then you need face value. But now it is saying dividend amount is ₹5. Okay, 1, 2, 3, 4 answers we have got. Yes, so some of the answers are 55. Let me tell you, there is one little mistake. There was a trap for you. And many people were caught in the trap. And the trap is like this. This is current dividend. And you need to put first year's dividend. So A1 will be 5.3. So if you are putting here 5.3, then it will become 58.88. That was the trap. It is current dividend. And you need to put first year's dividend. Any doubt to anybody on this? In fact, you can challenge this formula also. Why should I believe that somebody, Mr. Gordon, has given this formula and now they are asking me to follow it as it is? I disbelieve the formula. I will not follow the formula. Okay, if you don't want to use the formula, make your own table for a very long period of time. Say 100 years. So I'll fill series 100 years and sorry. Fill series column or let's say 130 years, long period. And then amount I'll put first year it is 4 rupees. Second year it is 4 rupees into 1.10, 10% growth is there, right? Second year it is first year amount into 1.10. And then I double click it. So it will keep increasing at the rate of 10% forever. And you know, this 4 rupees of dividend, if it increases by 10% per annum, in 130th year, I'll be getting 8,74,412 rupees dividend per share. 8 lakh rupees dividend per share. And then I'll calculate present value at the rate of 10%. I disbelieve the formula. I will make my own calculation. Why should I believe that this growth rate deduction in denominator is the correct way of doing it? So I calculate present value and then make a sum total of all present values. And look here, the answer is correct, 40 rupees. So if you disregard the formula and you don't want to use it, or under some circumstances it cannot be used, then make a table and calculate present value and make a sum total and you'll get the answer. And see, it's not very time consuming, just few keystrokes on Excel and you'll get the answer.
Tarun, one help. You did that series fill up. Where did you get that?
Oh yeah, I'll tell you, sir. So in the home tab, at last you will get one editing group, editing block. And there you will find this fill option. So first of all, if you want to fill a series, first of all, suppose I want to start the fill series at number 1. So first of all, type number 1. Oh, what is this happening? Just a minute. Some key has... Okay. So just type, give me a moment. I'm facing some problem in my system. Just type number 1, select it, and in this fill, probably my Excel screen is there. Oh yes, it is here. In fill option, you'll get series option. First, you need to type any number and select it, and then fill option in series option.
Got it.
Got it? And then column, you need to select column and then stop value. And then you'll be able to do it. Okay. Okay. So here we go for the next one. So guys, this is a basic idea of valuation. Now I'll tell you one interesting thing about it. Suppose this is how
Pratik? No, office done.
Okay. So, I'll give you one example quickly. Look here. You need to give me just 2 minutes time. I will disconnect and connect again. Just a minute, I'm facing some problem. If somebody becomes the host after my leaving, then make me host again. Okay, I can assign. So I am assigning it to Harsh sir to be the Okay. All right. So here we go. Yes, everybody, come on. I am here only. It was not a break. We will have a break at 11:30 around. I was telling you what is difference between income approach and the market approach and the cost approach. So let's assume that this life of any item is 4 years and the cash flows over 4 years period are 5,000, 6,000, 7,000 and 8,000 rupees. And say this is not a bond. Say this is a cow. anything we can assume, that's up to us. This is not a bond, this is a cow which has a remaining milking life of 4 years, and it will produce milk equal to, which will give you net cash flow of 5,000, 6,000, 7,000, 8,000. And you consider your investment in cow to be safe, and that's why your desired rate of return is just 10% per annum. So as per income approach, fair value of this cow, this cattle, is 20,227 rupees. So I did all the hard work, estimating life of the cow, estimating all future cash flows, that is how much will be the quantity of milk per month, what will be the selling price of milk per month, how much fodder or other things I'll have to give to the cow as a feed, and what medicines I'll have to give, and many more things I considered. I did all the hard work of estimating all future cash flows and calculating sum of present values, and now I say 20227 is the fair value. So value and milk, 20227 is the fair value, and this cow usually produces a milk of 2 liters per day. So what is the multiple, market multiple for this valuation? Have you learned in the market multiple approach? So there is price to earning ratio, enterprise value to EBITDA ratio, price to book value ratio, enterprise value to sales ratio, and many more valuation ratios are there. And I come up with a valuation ratio, value divided by milk per day. And the market multiple is 10,000 rupees per liter per day. This is the market multiple now. Now suppose I want to make valuation of a cow which produces 3.5 liters of milk per day. So how do I do valuation? I don't estimate life. I don't estimate all future cash flows. I simply say 3.5 multiplied by market multiple of 10113. So current fair value for this cow should be 35,397 rupees. This is market multiple approach, sir. If nobody has done income approach, if nobody has used the basic core valuation approach, other people cannot use market multiple approach. Some people must do the core valuation, then only other people can use market multiple approach, right? And then what is cost approach? Suppose in some situation, the data or situation is like this, you cannot apply either income approach or market approach. Then what is the cost of buying a calf? And then what is the cost of raising that calf to a cow? How much will I have to feed it and it will be ready to produce milk? That becomes the cost approach. That is the third approach of valuation. So we learned some basic concepts about valuation. Now, if cash flows are given, if discounting rate is given, then you can easily make valuation, right? Now you know that how to make valuation if cash flows are given and if discounting rate is also given. But a question arises, how do I calculate discounting rate, and how do I calculate cash flows. So let me tell you types of values. So we have one value of firm, and other thing is value of equity. People also name it as enterprise value, value of firm. Some people also name it as enterprise value, and sometimes there may be a difference between firm value and enterprise value also, but roughly I can say firm value means enterprise value. So with income approach, if you want to calculate value of firm, then free cash flow to firm, FCFF, should be discounted with free cash flow to firm should be discounted with weighted average cost of capital, that is WACC. But if you want to calculate value of equity, then free cash flow to equity, which is popularly named as FCFE, this should be discounted with cost of equity, and you can assign it a symbol KE. You know, let me tell you one thing. Even if you estimate value of the firm, then ultimately what do? You estimate value of firm, and then you deduct value of preference shares and value of debentures from the value of firm to eventually arrive at value of equity. So rarely people use value of firm for the purpose of transaction. Ultimately, they want fair value per equity share. So even if you are calculating value of firm, first you calculate value of firm, and then you deduct value of preference share, value of debenture, value of short-term loans to finally arrive at value of equity. But one thing is sure, that you need weighted average cost of capital and you need cost of equity. How to calculate cost of equity, how to calculate cost of debt, how to calculate cost of preference share, and then how to calculate weighted average cost of capital, that I will tell you. Just a minute, please. Okay, how do I calculate cost of debt? I can assign it a symbol KD, cost of debt. So this is YTM multiplied by 1 minus tax rate. Now YTM will be taught to you under fixed income securities chapter. And this is actually named as yield to maturity. YTM stands for yield to maturity. Right? What is yield to maturity? What is this thing? Nothing but a second name for internal rate of return. YTM is the other name for IRR. Look here now, IRR was 12.72%. So that was kind of YTM. That is, if the fair value is 20227 and the bond is available to at a discount to fair value, and if you buy the bond, then your rate of return will be more than the desired rate of return or the coupon rate. And this is actually YTM. So I can say that if for a par value bond, YTM is nothing but the interest offered by the company, that is the coupon rate. But if the bond is available at a discount, YTM will be higher. If a bond is available at a premium, YTM will be lower. This will be taught to you in fixed income securities chapter. As of now, for the sake of convenience, let's say YTM is nothing but the coupon rate. That is the rate of interest offered by the company. And then you multiply it by 1 minus tax rate. Say I have issued 10% coupon bonds and income tax rate is 30% effectively. So 1 minus tax rate is 1 minus 0.3, that is 0.7. So 10% multiplied by 0.7, this will give me 7%. 10% multiplied by 0.7, this will give me 7%, right? Now, can somebody tell me why this 1 minus tax rate thing is there? Why don't we say, if I'm paying 10% interest, my cost is 10%. How come this 7% thing? Right, Rohit Bajaj sir. Exactly. Yes, exactly. It is saving. Na? When you pay interest, it is debited to P&L account. It reduces your taxable profit and you have to pay less amount of tax. So when you give 10 rupees as interest, you save 3 rupees in income tax and your effective cost becomes 7 rupees only. Okay. Now cost of preference shares. This is simply YTM. Here you don't multiply it by 1 minus tax rate because you don't get a tax benefit on YTM. In preference shares, you don't get a tax benefit on. So if your company has issued 10% preference shares at par and it is redeemable at par, so YTM is 10% and your cost of preference shares will also be 10%. Now here comes the cost of equity. In case of debentures, it's easy that you pay a fixed rate of interest. In case of preference share, you pay a fixed rate of dividend. But in case of equity shares, there is no fixed rate of dividend. In fact, if you decide not to pay dividend for next 10, 20 years, you don't pay it. Nobody can sue that you are not paying dividend. So how to calculate cost of equity? So there is one wonderful approach, which is named as capital asset pricing model, CAPM. And CAPM says that cost of equity, that is desired rate of return of equity shareholders, is risk-free rate of return plus market rate of return minus risk-free rate of return multiplied by beta. You know what we are trying to figure out? Like we did in this question or any question, if you know cash flow, if you know discounting rate, you can calculate fair value. But what discounting rate should I use? Like in question number 1, I said a company is giving you 5,000, 6,000, 7,000 and 8,000 and you desire 10% interest. Why do you desire 10% interest? Or in question number 3, I said company will give dividend of 4 rupees, dividend will grow at the rate of 10% and equity shareholders desire a return of 20%. How come 20%? This was the question, hence the figure was given ready-made. But in your valuation assignment, nobody is going to give you a ready-made figure, right? So that's why we are trying to figure out this. Risk-free rate of return plus market rate of return minus risk-free rate of return multiplied by beta. Beta is regression coefficient. Statistical measure it is. Okay, let me quickly ask you one question. I need some money. I'm trying to start some venture. This draft valuers bill, probably you're aware of it, that there is one bill which has been made by government, draft valuers bill. If it becomes a reality, then scope of valuation will go up tremendously. In almost all act, then the registered valuer will be required. So that bill says that once this bill becomes a reality, this RVOs will be separate bodies and education institute will be separate body. Currently, RVO is giving you training and then giving you membership also. After this draft valuer bill becomes an act, then RVOs will just register the member and regulate the member, and education will be given by separate bodies. Okay. So suppose I am planning to start one valuation college, and for that I need at 10 places in India. And for that I will, oh, no, I'm not planning. That's just an example, Nikar. So, but I will need investment. Just teaching skill itself will not help me. So I'll need investment, and total initially I'll need 5 crore rupees of investment, and I'm in need of money. So I ask all of you that if everybody contributes here 10-20 lakh rupees per annum, then I will have at least 1 crore rupees from this batch. And I'll refund your money after 5 years with accumulated interest, and I'll give you 3% per annum interest. Say yes or no. Will you give me money? Yes or no? 5 years, 10 lakh rupees or 20 lakh rupees as you wish to contribute. 3% per annum interest I will give you. Sir, depends will not be acceptable. Current market scenario you already know, and I am asking in current market scenario only. Yes or no? Come on. I just have only 2 answers from Harsh sir and Rohit sir. 3, 4, 5, 6. Okay. 7. Hey, more people are there. And the correct answer is actually no. I'm giving you 3% per annum. Government of India 10-year bond is giving you, or 5 years bond is giving you 5.5 or 6% approximately. So roughly government bond is giving 6%, and Tarun Mahajan is saying that Tarun Mahajan will give 3%. Sir, इससे अच्छा ये नहीं होगा कि हम government bond खरीद लेंगे. Won't it be better that you buy the government bond rather than giving money to me? Even if, leave me, even if Mukesh Ambani ji comes and he says for Reliance retail expansion, I need money and I'll give you 3% per annum interest today. He is giving you this offer. So bond issue opens tomorrow and it will be closed within 1 month. Will you give money to Mukesh Ambani ji at the rate of 3% per annum to his company Reliance Retail? Yes or no? Come on, everybody. No, never. Because government of India is giving you better return, 6% per annum. That becomes your benchmark. Anywhere in India, if somebody is making investment, then his minimum desired rate of return is 6% per annum. That is the risk-free rate of return. Okay, what do I mean by risk-free rate of return? I have answered it myself. 10-year government of India bond return may be considered as risk-free rate of return. Do you think that government of India bond is actually risk-free? Can't they also make a default?
I think the probability is less.
Okay. Okay.
That's why it is considered as zero risk.
Right. Okay. Probability is low. Government of India default नहीं कर सकती क्या? That is what I am asking. Come on, everybody, answer this. Can government of India also make default? Yes or no? And the correct answer is actually no. As far as Indian rupee borrowing is concerned, they can never make a default. Because if they are out of money, if they are short of money, they'll publish it. They'll say RBI, come on, print 2000 की जगह मोदी जी बोलेंगे 5000 का नोट भी चला दो and distribute it among the people. They have the power to print money. There is no gold standard nowadays. Print as much money as you wish, number one. Number two, they have the power to tax you. So they can impose more taxes and recover more money and make good their borrowing. Or they can publish money. Though the value of the money will reduce, that's a different issue, but at least they will not make a default. But in international market, if you talk about government of India bond is not a risk-free bond, it is a risk-bearing bond. And the risk is so high that the government of USA bond, government Australia bond, international market rating is AAA, Standard & Poor rating. Moody's rating for Australia, USA, it is AAA. But in India, we don't secure AAA, we don't secure AA, we don't secure single A, we don't secure BBB plus, we don't secure BBB, we secure BBB minus. So sovereign rating of Indian bonds internationally is BBB minus. If government of India says we want to issue dollar denominated bonds, then it is BBB minus rated bond. It's a kind of junk category bond. It's not investment grade bond. It's junk bond internationally. But as far as rupee borrowing is concerned, there is no problem. And that's why in India, you'll consider this rate to be the risk-free rate of return. Let me tell you one very interesting thing. If you're going to make valuation of any Mexican company, so an Indian investor wants to buy a Mexican company which is registered in Mexico, which incurs cost in Mexico, which generate revenue in Mexico. An Indian investor wants to purchase that Mexican company, then don't take risk-free rate of return of India, then you will have to take risk-free rate of return of Mexico. If you're buying Canadian company, take risk-free rate of return of Canada. If you're buying a company, if you're planning to buy a company which is registered in Panama, a country where the law is so lenient that any kind of money laundering is done through Panama. So if a company is registered in Panama and 50% of its revenue is generated from Germany and 50% of its revenue is generated from Canada, then you will have to take a weighted average of risk-free rate of return of Eurozone and of Canada to arrive at a right risk-free rate of return for calculation of cost of equity. This RF appears to be very simple in CA final examination. Risk-free rate, take it 6%, solve the question. But in real life, this is not really easy. So your minimum expectation is set at risk-free rate of return, 6%. Even if God appears and say, I'll give you 5%, you will say, sorry, God, Government of India, Modi ji is giving me better return. I will invest my money over there. Safe, 100% safe. Okay, so now I'm changing my offer. Just after explanation of this formula, we'll have a tea break. Don't worry if you're tired. Okay, my offer is changed. Now Tarun Mahajan wants to start Education Institute for valuation. He will give you 6% per annum. Say yes or no. Will you give me money? Come on, sir. The voice, I want to hear you also. If yes, then why? If no, then why?
No. Actually, 6% is paying by government of India. So if I invest somewhere else, I would like to go for a higher rate.
Okay. Any other answer we have?
Benefited for the risk that I am taking, so it should be higher.
Okay. Yes. Any other answer?
what if there is a default? Then I definitely I would like to have more returns.
Yes, exactly. When you give me money, you are bearing a risk. You know, I have guided 2000 professionals in this valuation course, and I ask all those 2000 people with whom I have a contact that give me 10 lakh rupees. Then 2000 into 10 will become 20,000 lakhs. So that is 20 crore rupees. And I can fly to London, UK, favorite destination nowadays. Thereafter, if I collect huge amount. So that will be a trouble. I can be a defaulter. In current scenarios, in the current scenario, many people are becoming defaulter due to this COVID-19 situation. What if I become a defaulter? You're taking a risk, and so you deserve a risk premium. Now, how much risk premium do you deserve? It is here. RM minus RF multiplied by beta. Why? Why this is the risk premium? I'll answer this question immediately after the tea break. So it's 11:32. Let's have a break up to 11:45 a.m. Right, sir? Or let's make it 11:47. 11:47 sharp, we will start. Thank you. Okay, welcome back everybody to the session. If you can hear me, then I request you to please join it again. Even if you are holding a cup of tea or coffee, you can sip in front of the camera also, there is no issue. I don't have even the opportunity to ask to share the mug with me. Okay.
Tarun, where are you based right now?
Indore, Madhya Pradesh.
Oh, so coffee to Indore आके पीना पड़ेगा.
हाँ sir, that's the only way.
पोहा के साथ.
पोहा, अरे वाह, मतलब आपने मतलब क्या बात करी, मजा आ गया. आप you know about Indore, it means.
Yeah, I'm a big time foodie. So.
Okay, okay. सर इंदौर तो मतलब पोहा जलेबी का नाश्ते सुबह से चालू होके फिर रात को जलेबी एंड गराडू एंड व्हाट नॉट.
How's the situation there?
Comparatively better है सर. Like as compared to Delhi और मतलब महाराष्ट्र कर्नाटका के कंपैरिजन में देखें तो बेटर है. हाँ बट फिर भी पहले से बढ़ गए हैं केसेस. 200-250 केसेस पर डे हैं. पहले 100-150 केसेस पर डे थे. But now people are accepting it. And you know, I think it's everywhere कि लोग कुछ खास social distancing और मास्क भी ढंग से फॉलो नहीं करते. आधे लोग तो नहीं करते हमारे यहाँ पे.
साइकिलिंग हो रही है, साइकिलिंग एंड रनिंग?
नहीं, अभी थोड़ा सा ऑक्यूपाइड हो गया तो सर केवल मॉर्निंग वॉक ही चल रही है.
Just off the tangent a little bit, but connected with the Excel. There is also a formula where you calculate a formula and then you can do a backward thing, guess.
That is goal seek.
वो कहाँ पे है? Can you just?
मैं बताता हूँ. I'll demonstrate it in fact. So this IRR can be calculated with goal seek also. If you are not using IRR, you can use, suppose, say this is, rather than calculating IRR, if I plan to calculate, okay, this is NPV, and then I'll not disturb it, rather than I'll create it afresh. Present value, now I'm telling you goal seek function, present value of inflows, and then there is present value of outflows. How to calculate, and this is the rate, discounting rate. Suppose discounting rate is currently 10%. Rate is 10%, and I use NPV to calculate present value of inflows 5, 6, 7, 8,000. Okay, I'm sorry, I have not entered the rate. I give cell reference for the rate, and then I select 5, 6, 7, 8,000 to calculate present value. This is present value of inflows. Suppose outflow is 19,000, so I type here minus 19,000. And then the actual NPV, not the Excel NPV, but actual NPV is present value of inflows and present value of outflows. So NPV is positive. Now by definition, internal rate of return is the rate at which NPV is 0. So if I'm discounting at 10%, I'm not getting 0 NPV, I'm getting positive NPV. So I try at 11%, NPV is still positive. I try at 12%, NPV is still positive. I try at 13%, now NPV has gone negative. I need a rate where NPV becomes 0, and actually that rate will become internal rate of return. So here in Excel, in the data tab, what if analysis you will find on the ribbon. Click that what if analysis and then you will find goal seek. So click that goal seek and it is saying set cell. Which one? G12, which contains 10% rate. No, I'm sorry. Set cell this 1227, G15 to 0 value. I want it to arrive at 0 value by changing cell. Which cell? This 10% cell. And then you say okay. Let me put it up to 2 decimal points or 4 decimal points. So this is goal seek. Put a rate here which makes NPV 0 and Excel automatically gives you answer 12.7226. Let's do it again. So this is 10% here I put, then in data tab, what if analysis, goal seek. I click this 1227. I want to set it equal to 0 by changing this cell. I say okay and it calculates and okay. And then it gives me this figure. Just observe it. Okay. Right. Great. So let's move ahead. We were discussing this thing, right? CAPM. So you deserve a risk premium also. A question arises, how much risk premium do you deserve? You know, here the theory of comparative satisfaction of human nature comes into role. William Sharpe, who proposed this CAPM model, who got a Nobel Prize also for this contribution and for his several other contributions, he says that investor desire a risk-free rate of return, which is RM minus RF into beta. Now the question is, why RM minus RF into beta at all? So I hope other people whose video is not on are also there with us. Lokesh ji, Nikhar ji, Surinder sir, somebody from HP Laptop, Ashwin sir, and Rohit Bajaj sir. Okay, Rohit Bajaj sir is here, but looks like Lokesh ji, Nikhar ji, Surinder ji, Ashwin ji, and somebody from HP Laptop, they are not there. I request you all to join as soon as possible. Okay, you are here. Okay. All right, great. Because now this is going to be important discussion. You know, the human has a nature of comparative satisfaction. If I'm rich and you are super rich, I still have a jealous feeling that why not I'm super rich, I'm just rich. This is the human nature. So here we are using that human nature to define how much risk premium do you deserve. So say I am a newly qualified chartered accountant and in a campus interview, I get a package offer of 10 lakh rupees per annum. But one of my friends who took 10 attempts to clear, he was my senior, now he is my friend. And his otherwise also he is like a dumb. Not only examination, but practically also his knowledge is very poor. He also got the job offer in the same company and they are giving him 20 lakh per annum. So I was really happy that I am getting a job offer for a package of 10 lakh rupees per annum. So my happiness should be tripled now. I am getting 10 lakh. My friend is getting 20 lakh. Together we are getting 30 lakhs. Will I be happier? Or my happiness will reduce? Never. My happiness will reduce. In fact, I'll be sad. In fact, I'll ask the company HR that what is this? He's getting 20 lakh. I am better than him. If you are giving him 20 lakh, I deserve 30 lakhs. So the guy will say, no, we cannot increase your salary. I'll say, okay, in that case, reduce his salary to 5 lakh rupees. So this is how it happens. We get comparative satisfaction. So this here RM is return on a well diversified market portfolio. Say Sensex. So Sensex comprises 30 shares and Nifty, it comprises 50 shares. And when I talk about Sensex or Nifty, in that case, it's a well diversified portfolio. They have not invested, they have not included only one industry share. They have included many industries, many group of companies. Their portfolio is actually diversified. So when you diversify the portfolio, there is one advantage that you don't bear the company risk. Because if you are invested in 50 companies, 50 best companies in India, and some of the industries, some of the companies are coming down and some other companies are going up and some other companies are stagnant, then this coming down and going up, they will cancel each other. And your company's specific risk will be eliminated and you will be bearing only the whole economy risk. If entire market is falling down due to COVID-19 or any other thing, so that risk is still there. If entire market is falling down, all my shares will fall down. But the company is specific risk. Some companies are giving good news, some companies are giving bad news. So that will be cancelled out. So RM means return on a well diversified market portfolio, like you have Sensex or Nifty. So let's take one example. Suppose the risk-free rate of return is 6%. Nifty is giving 14% return historically on an average. So those who have invested in Nifty, they are getting 8% extra. Why they are getting 8% extra? Risk-free. Government bond people are getting just 6%. Nifty people are getting 14%. Why Nifty people are getting 8% extra? Come on, wrong answers are acceptable. No answers are not acceptable. Yes, because of higher risk. Exactly. In government bond, you don't bear any risk. In Nifty, you are bearing huge risk. So this 8% extra is the risk premium if you will get if you invest money in Nifty 50 securities. But what is happening over here? I am not going to invest in Nifty. I am going to invest in some ABC Limited, PQR Limited, XYZ Limited. So that company has beta of 1.5. I am investing in ABC Limited. ABC Limited has a beta of 1.5 as compared to market. Now, beta is a regression coefficient. In easy words, I can say it is the risk index. Beautiful thing. Beta is not measurement of risk. No. It is index of risk. Beta is not measurement of risk. Rather than it is index of risk. Suppose I ask Preeti ji that Preeti ji, what is your annual income? That question to ask somebody, especially publicly. But Preeti ji is very smart and she replies, Tarun, my income is double as compared to yours. Now when she say double, this is not measurement of her income. This is the index of her income, where my income is the base number and double is the index of her income. Similarly, this beta is not measurement of risk minded. Sigma, standard deviation, that is measurement of risk. But beta is not measurement of risk. It is the index of risk. So if beta of my security is 1.5, it means that my security has 1.5 times volatility as compared to Nifty. So if Nifty goes up by 10%, ABC Limited share will go up by 15%. If Nifty comes down by 10%, ABC Limited share price will come down by 15%. So ABC Limited is riskier than market. So I deserve 6%. You know, what is CAPM? It tells you manners of expecting return. Anywhere in your life, if you expect too much, then you will lose the opportunity to get the reasonable one also. If you expect too less, you'll get that much only. Suppose a client approaches you for, company audit, and he asks for the fees. Sir, what fees you will charge? And reasonably, you should charge 25,000 rupees because it's not a big work. And you quote 1 lakh rupees. For 25,000 rupees, you're quoting 1 lakh rupees. How much will you get, sir, from the client?
No work.
Exactly. You will get nothing. Client बोलेगा कि मैं bargain भी नहीं कर सकता, आपने इतनी बड़ी फीस कोट कर दी है. So he will not even say bye bye. He'll go away. He'll get zero. That's perfectly right. Expect too much and get nothing. And expect too less. Client is asking how much you'll charge and say only 5,000 rupees. And he say, yeah, immediately do it now. Probably he'll bargain in that also. Why not 4,000? But he will immediately give that work to you and he'll get that much only. Expect too much and get nothing. Expect too less and get that only. So expect reasonable one. That is more important everywhere, including in investment world. So I deserve minimum 6% return because that is the risk-free rate of return. Plus I deserve risk premium. Those who invest in Nifty, they are getting 8% risk premium. I am taking 1.5 times risk as compared to Nifty. So I deserve 12% risk premium. So 6% I need because that is everybody is getting. 12% extra I deserve because I am taking 1.5 times risk as compared to market people. And that's why I deserve 18% per annum return. Right, sir? Now, we don't have much time. So rather than asking question to you, I'll explain one interesting thing to you. Okay. Risk-free rate of return. Okay, at least allow me to ask at least one question then. You are asking 6% interest from Government of India bond. Hey, that bond is risk-free. Higher the risk, higher the return. Zero the risk, zero the return. Why 6%? Give me one good reason.
Inflation.
Oh, perfect. That's perfect. You give money to Government of India today and they'll give you money back after several years. So the purchasing power of the money would have reduced, and that's why inflation is there. So can I say safely that if there is no inflation in our economy, then we will ask 0% return from Government of India bond? Opportunity cost, that answer is a broad one. We need some pinpointed answer. Yes, but I appreciate that you answered quickly, sir. Okay, give me one moment. Return on investment is required. Current consumption. Yes, that's right. That's right, sir. That's right. you know, you earn money because you want to consume it ultimately. There is a Hindi saying, na, dhan ki teen dashaएं, dan, bhog, nash. So ultimately, you'll have to do something with your money, na? So you will have to consume. You want to consume your money. But if somebody comes to you and say, give me this money, you are going to buy a sedan car for 15 lakh rupees, and I come to you and I say, okay, you can buy the car after 3 years. I need money urgently. So you're sacrificing your current consumption. Compensation for deferment of consumption. That's why these two items together, they form the risk-free rate of return. And then risk premium. You know, sometimes in real life situations, CAPM fails. In that case, you can use the sum of parts method. That is, I deserve rate of return due to these 5 reasons, and 2% for this, 1% for this, 3% for this, 4% for this. In total, I need 15%, something like that. That's why we are learning this breakup value. Risk premium comprises or risk premium depends on degree of risk aversion. Aversion means hate for the risk. So usually you don't love to take risk. You hate to take risk. You don't love to take risk in general as a human. You hate to take risk. But if somebody push you, oh, come on, go and take the risk, then for taking the risk, you want risk premium. If your hate for risk, if your fear for risk increases, mind it now. If your fear for risk increases, then for taking same 1 unit of risk, you will start asking more risk premium. You know, this COVID-19, it gave a shock to the market. Market again recovered to the great extent, but still it gave a shock. If market keeps on giving you shocks, then you will have bad experiences in the market. And you will say, no, I am very fearful with respect to this market. I hate this market. If your fear for the risk increases, then for taking same 1 unit risk, you will start asking more premium. Rather than 8%, you will ask 9 or 10%, something like that. So risk premium depends on that. And then risk index for market related risk. Risk index means beta. Higher the beta, higher the expectation of return. Now there is one interesting thing. CAPM, capital asset pricing model, assumes that the investor is a well diversified investor. He has bought shares in cement company, steel company, FMCG company, software company, electricity company, banking company, insurance company. All types of companies he has made investment. His portfolio is so much well diversified that company specific risk has gone down to 0. Some companies are falling, some are rising. It is cancelled out. No company risk is there. So CAPM assumes that, and that's why it offers risk premium on beta only, and beta is the risk index with related to market risk only. But when you get an valuation assignment and your client is suppose going to start a new venture and he will be selling some stuff. So he'll be manufacturing this mugs, you know, the bone china mugs or something, some ceramic work, ceramic pot work he is starting. So your client is not well diversified. He is into only one kind of manufacturing business. That's why he is bearing company specific risk premium also. And therefore, in valuation assignment, what do people do? First, they apply CAPM and then they say, okay, guys, CAPM is fine, but I'm taking extra risk, company specific risk. And that's why I deserve extra risk premium. And this 3% extra is for company specific risk. Market risk is already covered in CAPM, but company risk we can add separately, and then we can say I'll discount cash flows at the rate of 21%. Right, sir? So this is how entire thing goes like. How do you calculate beta? I can quickly tell you how beta is actually calculated. You know, if you want to calculate beta, I'll give you one quick example on this. I hope my Excel screen is shared. Yes, it is. Calculation of beta. So suppose I take some historical data for 5 years. In real life, I take at least 20 years data. Here I am taking example of 5 years. So Sensex has given me a return of 10%, 15%, minus 3%, 6% and 12% in the last 5 years. And ABC Limited, which is listed on BSE or NSE or both, it has given me return of 15%, 30%, minus 10%, and 0%, and then 12%. Historical return for last 5 years for Sensex as well as for ABC Limited. So what is beta? First, I'll tell you what is beta, and then I'll tell you how to calculate beta. So I take here, you know, this is, I'll draw a graph. This is x-axis. This is y-axis. On x-axis, I take return on market portfolio. That is actually Sensex. And on y-axis, I take return on investors portfolio. That is ABC Limited. So in first year, Sensex has given me return of, 5 and 5, 10% return. And in first year, this share has given me return of 15%. So 10% on x-axis, 15% on y-axis. So I'll be able to draw a point somewhere here. Look here, this is the point. If I take data for last 20 or 40 years, Sensex has a history of 41 years as of now. If I take data for last 40 years, then this data will be scattered like this, probably, okay? Now, if somebody tell me to draw a line which joins all these points, I cannot draw a straight line to join all these points, but I can draw a line of best fit. When I say line of best fit, means a line where distance of points above the line and distance of point below the line is same. Or roughly I can say number of points above the line and number of points below the line are same in number. Right? So this is the line of best fit. It is also named as regression line. Now what do? I draw a line parallel to x-axis and then try to measure this angle of this line with respect to x-axis, which is named as theta. Suppose this theta, say this looks like, currently this looks like 45 degree. So now I calculate tan theta, sin theta, cos theta, tan theta, trigonometry, mathematics. So what is beta? Beta is nothing but tan theta. Tan 45 degree value is 1. Here beta is 1. Tan 0 degree is 0. This is 0 beta. This is 1 beta. This is between 0 and 1. 0, less than 1, 1, more than 1, more than 1. This is beta. But that looks really very complex. Don't worry. And thanks to Microsoft company that they have given us a ready-made tool to calculate beta, and you can use slope, S-L-O-P-E, slope function. You want to measure slope actually. You actually want to measure slope. So first you take y-axis, that is ABC Limited, and then you take x-axis data. So that is Sensex. Always put Sensex or Nifty on x-axis. Select this, press enter, and see here. Beta here is 2.05. Suppose I reduce it to 20%. So more reliable example it will be. This is how 1.7. This is the beta. This is how you calculate beta. Right, sir? You know, beta in rare short-term situation, beta can be negative also. If the upward sloping line is there, beta is positive. If the downward sloping line is there, beta will be negative. So in short run, some of the companies may have a negative beta also. Negative beta means your direction is opposite as compared to market. So under COVID-19 situation, when most of the stocks were falling and Sensex and Nifty were falling, some of the pharmaceutical stocks were rising, opposite direction. Temporarily, for a short period of time, beta can be negative, but for a long period of time, practically, we don't find negative betas. And if beta is negative at all, then put negative beta and accordingly calculate your return. But in real life, you will not find beta negative because you take 20-40 years data, and in that period, you don't find opposite direction as compared to market. So this is how beta is calculated, and then you apply. Yes, sir.
Tarun, I am applying this formula, and the answer is coming at 0.429.
0.429.
35.
So are you using a formula? Let's check. Equal to first you need to take ABC Limited. Probably you have done reverse.
Okay, got it. So you have to take the is this an exam question?
No, I have created this right now. So known Y's, first you input Y. Y means dependent. So share is dependent and X means independent. So the market is independent. Nifty is not dependent on ABC Limited. Sensex is not dependent on ABC Limited.
सर अगर हम ये परसेंटेज जो रिटर्न का है इसको अगर रिप्लेस कर दें जो शेयर्स का प्राइस है, शेयर्स के प्राइस है उससे, तो क्या हम बीटा निकाल सकते हैं?
नहीं, शेयर के प्राइस से हमको फिर थोड़ा मिसलीडिंग रिजल्ट मिलेगा क्योंकि वो एब्सोल्यूट नंबर है. जैसे स्टैंडर्ड डिविएशन भी जब हम कैलकुलेट करते हैं ना, तो एब्सोल्यूट नंबर का स्टैंडर्ड डिविएशन अलग आता है और रिलेटिव नंबर का स्टैंडर्ड डिविएशन अलग आता है. So we can give it a try. Let's take some data like this, 200 and double it to 400 and double it to 800. And here I can take 300 and 450.
These are relative figures. They have to be in percentage terms.
I'm just checking it. Let's just check it. These are share prices, right? And if I calculate return with this share prices, so return will be like this. Let's do it. It will not take a great amount of time. So now let's calculate beta equal to slope. bracket open, known y's, and then you take known x. So this is here, and here I do equal to slope. So this is known y's. Then you take known x. Okay, let me change it to 700. See, it is not same. So these are the absolute numbers, and these are percentage return, and that's why it's not same. And therefore you should take percentage return only. Number two, if you are taking just absolute price, you will be ignoring dividend. While in calculation of return, one should also consider dividend. How? I'll tell you. So look here, like this 15%. How do you calculate this 15% return? So return for year 1 is equal to dividend for year 1. Moral of the story so far is don't take Sensex as a number, calculate its percentage return. Don't take security price as a number, calculate its percentage return, and then try to calculate beta on the basis of percentage return. But how to calculate percentage return? So return for year 1 is dividend for year 1 plus price at the end of year 1 divided by price at the beginning of year 1, that is 0 year minus 1. So suppose company has given a dividend of 10 rupees, year end price, all imaginary figures. Year end price is 220 rupees, year beginning price was 200 rupees, say for example. So 200 rupees you bought the share, year end it has gone up to 220. Also it has paid a dividend of 10 rupees. Minus 1 is there because you want to eliminate principal 1 rupee and you just want to consider return. In percentage format, it is 15%. So this is how you calculate percentage return for a year which considers dividend also. Besides, appreciation in price is just 10% and dividend yield here is 5%. See, 200 share has gone up to 220. Appreciation in price is 200 and dividend yield is 5%. The appreciation in price is 10% and dividend yield is 5%. So total return is 15%. And that's why you should put here return only, number 1. Number 2, looking at these numbers, now there is a new challenge. And the new challenge is you cannot calculate beta for unlisted companies. Because in case of unlisted companies, you cannot calculate return. Why can't you calculate return for unlisted company? Because to calculate return, you need price at the beginning and at the end of each period. Market price. Unlisted company is there, so no market price, hence you cannot calculate return. You cannot calculate return, hence you cannot calculate beta for unlisted company. Then how to calculate beta for unlisted company? That we will see. But before that, now you know how to calculate cost of debt, cost of preference share, and cost of equity share. So the next step is
speaking.
Yeah, please.
Hi, how are you doing?
Okay,
hello.
So I need to mute properly.
Go ahead, Dhar. Hanji, how are you, sir?
I'm not the host. Can somebody make me host?
नहीं sir, वो weekends में होती हैं, Saturday, Sunday. It's a webinar for 8 hours every day.
Okay.
So
Vijay sir is the host now. Rohit sir is probably not able to hear us. उन्होंने अपना speaker बंद कर दिया है शायद. Rohit sir.
Yes, please.
Please mute your microphone. Okay. Right. So I was telling you, okay, how once you know cost of debt, cost of reference, and cost of equity share, now you can calculate weighted average cost of capital. How to calculate weighted average cost of capital? Simple, as the name suggests, you take cost of debt multiplied by amount of debt. Then you take cost of reference share multiplied by amount of reference share. Then you take cost of equity share multiplied by amount of equity share and then divide by total of the weights. So So this way you can calculate weighted average cost of capital. Now, an interesting thing here is, while calculating weighted average cost of capital, market value weights are considered to be better than the book value weights. If at all market value weights are available, like debentures have balance sheet value of 10 crore, while its market value is just 9 crore. So put here 9 crore. Equity shares, so paid up equity share capital plus reserves and surplus has a book value of 100 crores, while its market value is 150 crores. So put here 150 crores. If at all market value weights are available, then market value weights are better than book value weights. Let's do one question on it. Simple question. You won't need Excel. Your normal calculator will help you to solve this. Calculate WACC with the help of following information. Now I'm giving you 3-4 minutes time. Do it yourself, sir. And everybody must do it.
Sir, it is 14.16%. Is it? Hello?
Okay. Has everybody done it?
क्या करना है minimize करके कर लो.
Sir, 14.16%.
तो बताए हिमांशु.
14.6.
14.16.
Okay. Let's
14.1.
That sounds correct. Let's see, the cost of debt is gonna be
8.4%.
multiplied by 0.7, that's 8.4%. And the cost of equity is gonna be 18%. And then weighted average cost of capital, they have given a ratio 2:3. That is 0.4 and 0.6. You can either give the weight or 2 or 3 and then divide it by 5. So 14.16%. Yes, that's the right answer. Everyone, please check it. I just request everybody that after using microphone, turn it off, because now I'm not the host. I cannot mute your system. Once you get the answer, please post it in the chat box so that I'm aware that everybody has done it.
Tarun, just sharing a small tidbit with you.
Yeah, please.
We had financial management in 1983 when I passed my finals, but we used to get a table for the NPV and PV's values. And I just remembered we were not allowed calculator, but we used to get NPV tables for different discounting rates at different periods.
Oh,
and
wow.
That's how we did those questions of present value and so on. I'm recollecting it now.
I have written many recommendations to ICAI that there is one special financial calculator which make all these calculations like quick. They don't allow it. Even international CFA exam it allows. So what do we do in classroom? We teach calculator technique. You press this, so many times equal to, then into, then divide, and then you'll get the answer. Now that is rubbish, because that checks how do you operate calculator. They should allow financial calculators. There are special financial calculators in the market which calculate NPV, IRR, everything readily, so that at least student can focus on analysis part. But what they are learning is how to calculate.
Sir, I still remember of class incidents कि आप जब calculator खोलिए उसको फिर divide by 10 times. I still remember this thing.
बिल्कुल सही बोल रहे हैं आप. This is how अभी भी क्लास में वही चलता है. इतनी बार equal to, इतनी बार into, इतनी बार under root. Do it like this. Can't help it. Right. So everybody looks like got the answer. Fantastic. So I was telling you, you cannot calculate beta for unlisted company. You know why? Because first you need to calculate beta, you need percentage return. To calculate percentage return, you need market price per share at the end of each year. Your company is unlisted, you don't have market price per share, hence you cannot calculate return. Hence you cannot calculate beta. But reality is this: whatever valuation assignment you get, most of your valuation assignments are for unlisted companies only. Because in law, there are more places where unlisted company is required to get valued their shares as compared to listed companies. because listed company price discovery already happens through stock exchange. So you are getting valuation assignment for unlisted company, but you cannot calculate beta of unlisted company. So what to do in that case? Follow the pure play technique, which is also named as bottom up beta approach. Follow pure play technique, which is also named as bottom up beta approach. What do you do here? You look for a comparable listed company. So if my company is a steel sheet manufacturing company and we are doing CR process, cold rolled steel sheets we are manufacturing, CR steel sheets we are manufacturing, okay? And I'm unlisted company. I want to make valuation of this unlisted company, which is steel sheet manufacturing company. So I look for a comparable company. That is a company which is also into steel sheet manufacturing. A company which is similar in size. We are having 2,000 crore rupees of revenue. So they are also having 2, 3, 4, 5,000 crore rupees of revenue, but not 1 lakh crore rupees of revenue. Same in size, same in geographical location, same in the product, same in the process. Try to find as comparable as possible. But do not apply too many filters. Otherwise, you will not find a comparable company. Okay. It is just like finding a bride or groom for somebody. If you apply too many filters, so the girl or boy has his own choice, and the parents have their own choice, and the grandparents have their own choice, and everybody put a filter, narrow down, you will not find the counterparty. So if you are trying to search a comparable company, try to find as much comparable as possible. But sometimes you don't find a comparable company. Then you need to rely on the industry. What is the industry average? Something like that. Find a comparable company which is listed. Calculate beta for that listed company. Suppose beta for that steel sheet manufacturing company is 1.4. So I'll say that is steel sheet. I'm also steel sheet. Their beta is 1.4 because they are listed. I can calculate their beta. So my beta is also, 1.4. I'll copy and paste their beta. But as there is a Hindi saying, nakal karne ke liye bhi akal chahiye. You cannot simply copy paste their beta. Yes, you are comparable, but probably your debt equity ratio is not comparable. That listed company has debt equity ratio of 2:1. Your company has a debt equity ratio of just 1:1. So your business risk is same, but your financial risk is not same. They have higher financial risk due to higher debt equity ratio, and you have lower financial risk due to lower debt equity ratio. And beta represents both business risk and financial risk. You cannot use their beta as it is. You need to adjust their beta. How do you adjust their beta? Take their beta, which is 2:1 ratio. If a company has a loan in its capital structure, if a company has any short-term or long-term loan in its capital structure, that company is called levered company, levered. And if it is purely financed by equity, no long-term, short-term debt, then it is called unlevered company. So I'll take their levered beta, make it unlevered. I'll take their unlevered beta, make it unlevered, and then lever it again as per my debt equity ratio requirement. This is called the pure play technique or bottom up beta approach. One single numerical will make it clear. I was just giving you framework. Don't expect yourself that you got what I said. I was just giving you framework. One question will make it clear. What to do with tax planning or tax evasion done by any company which we are considering for comparison of. Now this is the problem, Nikhar. What happens actually, that you have to believe that whatever financial statements you're getting for the comparable company, that gives a true and fair view. Because those are audited financial statements, and let's believe that the auditor is tax planning is a different issue. So let's believe that whatever is there, it's correct. You know, if you find a comparable listed company, then there are less chances that that company must be doing some extraordinary tax planning, or that is doing tax evasion, let's say. So it's not just about tax planning. It may be about anything and everything, the management style they are having. So suppose I'm a company which manufacture and supply steel in south part of India, and I found a comparable listed company which manufacture and supply steel in north part of India. They may be different in geographical location. They may be different in management style. They may have superior management as compared to the management of my company. So you'll find many, or you are saying tax, the unit is situation in special economic zone. So my unit is not situation in special economic zone. So there may be sometimes I'm saying you don't find a comparable company at all. In real life, finding a comparable company which is listed is very difficult, because unlisted companies are doing some small level activities which big listed companies don't do at all. We don't do this. Then you try to fit your company into some industry, and then you take the industry beta and go ahead with that. This is how you make adjustments. Okay, so the comparable company has higher level of leverage. What do you do in that case? So there was one gentleman named as Mr. Robert S. Hamada. He gave us a formula which we name it as Hamada formula. How to use Hamada formula? It says beta L is equal to beta U into 1 plus debt equity ratio multiplied by 1 minus tax rate. What is beta L? It is equity beta of levered company. What is beta U? It is equity beta of unlevered company. Both are equity betas, but one is for levered company, other one is for unlevered company. T is the tax rate, debt equity ratio is here. When I say debt, it includes both long-term and short-term debt. Similarly, in weighted average cost of capital, when I say cost of debt, it includes both long-term and short-term. Here, there may be a difference in what you study in books and what is the practice. So when you study in CA intermediate or in CA final, there you consider only long-term debt to be part of weighted average cost of capital. But in practice, people take even short-term debt also as part of weighted average cost of capital. Okay. So I will take levered beta of listed company over here and put debt equity ratio of listed company here. And as a balancing figure, I will calculate unlevered beta from 2:1 to 0 debt level. But I am also not unlevered. I am also levered at the rate of 1:1. So I will lever it again at the ratio of 1:1. Okay, just observe this formula and answer my one question, preferably by voice with an explanation. Which one will be a higher number? Beta L or beta U?
So it's maybe can be higher or lower as well as कुछ भी हो सकता है. It depends on debt equity ratio. अगर debt ज़्यादा है तो ये it will be higher. Otherwise it will be lower.
Okay. That's one answer. Thank you. I'll repeat question. Which one will be a higher number, beta L or beta U? Just think about it and post your answer. Okay, Rohit ji is saying, Rohit Bajaj sir is saying beta U. Amit Agrawal sir is saying beta L. Three answers only, 4 total. Not sure. Okay, let me explain then. Look here, beta L, beta U. So beta L is equal to beta U multiplied by this bracket. What is inside the bracket? It is 1 plus something. You know, we are talking about a levered company's beta. So levered company must have at least some amount of debt. And even with some amount of debt, 1 plus something is a number which is more than 1. I'm talking mathematically, just. So inside the bracket, you have a number which is bigger than 1. Say 1.1, 1.2, 1.5, maybe 2.6, whatever it is. Beta U multiplied by a number which is more than 1 will fetch a result which is more than beta U. Isn't it, sir? So it's like, suppose beta U is 2 multiplied by, inside the bracket it is 1.5. So 2 multiplied by 1.5 will give you 3. So 2 is your unlevered beta and 3 is the levered beta. And that's why I'm saying beta L will always be more than beta U, because L is for levered and U is for totally unlevered. Right, sir? Logically speaking, levered company has borrowed money. So when you borrow money, you bear financial risk. When you borrow money, you bear financial risk. So that's why your risk, besides business risk, you have financial risk also. You have more risk, and that's why beta L should be higher. Let's do one question that will clear your concept. An unlisted company has debt equity ratio of 2:3. Unlisted. Your company is unlisted. It has debt equity ratio of 2:3. 2:3. Sometimes it may confuse some people. So let's say it is 0.67:1. So this is the debt equity ratio, which is 0.67:1. So your amount of debt is less than your amount of equity. While its comparable listed company has a debt equity ratio of 2:1, double debt as compared to equity, and equity beta of 1.5. Now tell me one thing, this 1.5 beta, is it the levered beta or is it the unlevered beta? Beta L or beta U it is. So I have got only 2 answers. Okay. Okay. I request everybody to read the question carefully again, the highlighted part, and then try to answer it now. Don't try to pass it, rather than try to answer it. Okay. Levered, some people are saying. Hmm. Actually, it is levered beta, sir. You know why? Its comparable listed company has a debt equity ratio of 2:1. You found a comparable company. That comparable company has debt of 2:1. So that company is levered. You know, listed company which you found has a debt equity ratio of 2:1. It means that company is levered. And that's why its beta, which is 1.5, is also levered. Is it clear? आपने एक ऐसी कंपनी ढूंढी है जो लिस्टेड है, जो कंपेरेबल है, उसमें डेट इक्विटी रेशियो 2:1 है. So its beta must be levered beta. This is levered beta. Let's put it at the place of levered beta. And then try to figure out unlevered beta. So 1.5 is equal to beta U into 1 plus debt equity ratio. Debt equity ratio is 2:1. So try to solve this. Calculate beta U as a balancing figure. Amit sir has got 0.88, Rohit Bijaj sir has got 0.625, Ajesh Jain sir has got 0.625, Lokesh ji has also got 0.625. You don't need Excel, huh? You can do it on your calculator. Preeti ji, try to do it. Subbu sir, 0.625 you have got. Okay. Jacob sir, please try to solve. I know this might be a little heavy for you because we are trying to dive into finance. So
I'm getting 62.5%. I don't know where I put the percentage formula wrong.
Percentage formula, you're doing it in Excel, sir?
Yes.
So Excel automatically takes it. Just do Control+1.
Okay, I got it.
Formatting window will be there. Instead of percent, choose number. Right, 0.625. That's the correct answer. You know what is moral of the story here? This listed company, which has 2:1 debt equity ratio, if it repays entire debt, then its beta will drop down from 1.5 to 0.625. If this company repays entire debt, then its beta will drop down from 1.5 to 0.625. But 0.625 is of no use for me. Why? Because my company is also levered and the ratio is 2:3, that is 0.67:1. So I dropped it down to unlevered level, and now I will lever it again as per my requirement. So I'll use this formula again. And this time I will say beta L I want to calculate for debt equity ratio of 2:3 equal to beta U 0.625 into 1 plus debt equity ratio. Debt equity ratio here is 2:3. Two is to 3 into 1 minus 0.3. Try to solve this. Yes, that's the right answer. 0.917. Correct. Now this is my beta. I can use this beta. My company is levered. So now I can use this beta, 0.917. Now question has also provided me with cost of equity and risk-free rate of return. So try to calculate risk-free rate of return and market return. So try to calculate cost of equity. Exactly. 14.59% is the answer. Okay, guys. So now let's move for the next. As I told you earlier, that if you want to calculate value of firm, then free cash flow to firm should be discounted with weighted average cost of capital. But if you want to calculate value of equity, then free cash flow to equity should be discounted with cost of equity. Now we know how to calculate weighted average cost of capital. We also know how to calculate cost of equity. The question now is how to calculate FCFF, free cash flow to firm, and how to calculate FCFE, that is free cash flow to equity. This is going to be very important. Look here. So this free cash flow to firm We are going to explore these two phrases. I'll break it down into three parts. One is free, then one is cash flow, and then one is firm. So now, even if you lost track of some of the previous concepts due to depth of finance, we are starting now a new concept. So you can give it a fresh start now. It's not linked to what we have already gone through. So you can start paying more attention now. It's a new concept now. I will break down this phrase also into three parts: free, cash flow, and then equity. So first of all, here we are not talking about profit. Here we are talking about cash flow. So if you have the amount of net profit, you add back all expenses which are non-cash in nature. Primarily, it is depreciation. So once you have net profit as per profit and loss account, add back depreciation. Just a minute, please. I need 1 minute's time. Okay, so if you have net profit in your hand, the next thing that you have to do is add back depreciation and any other non-cash expenses, amortization, impairment loss, loss on sale of asset, etc. Any non-cash item is there, you add it back to get cash flow. We are talking about cash flow, not about profit. Number one. Number two, we are talking about free. Now, what is free? So this year my net profit was 1 lakh rupees. I add back non-cash expenses of 50,000 rupees. So my cash profit is 1,50,000 rupees. And I say, hooray, I got 1,50,000. Let's distribute it. Enjoy this money. No, I cannot. Because whatever amount I earned from this business, a part of that amount will be reinvested in this business itself. That's how the business will be able to maintain its earning capacity, or that's how the business will be able to grow at a normal rate of return. So out of 1,50,000, 60,000 rupees is reinvested in the business itself. So if the cow is producing milk, a part of it definitely goes to its own calf. That's why it is producing milk. So 60,000 rupees is reinvested out of 1,50,000 rupees of income. Now 90,000 rupees is freely available for the purpose of distribution to investors. That is free. So when I say free, it means after making capital expenditure this year, after making investment in working capital, after making investment in shares of other companies like subsidiaries or associates, etc. After doing all these reinvestments, whatever is left is free. What about the tax part? So tax is deducted because tax is, something which you have to pay. So you don't add back tax. Because after paying tax, you can distribute dividend to equity shareholders. Right, sir?
Karan, I have a question.
Yes, sir.
For determining the deduction for the working capital, now working capital obviously will exclude the bank borrowings.
I'll come to that point, sir. So this is just an introduction and I will come to that point. We'll detail and discuss. This is just an introduction. Now there is firm and versus equity. When I say equity, it means only equity shareholders. So whatever amount is available to equity shareholders is free cash flow to equity. But when I say firm, different people can define firm in different manner. So some person can say only equity shareholder are part of firm, all other people are outsider. Somebody can say equity share plus preference share together, we will name it as firm, and all other people are not part of firm. Some people can say equity share plus preference share plus long-term borrowing together, that is firm. Some people will say equity share, preference share, long-term debt plus short-term debt, the bigger circle. Now we are firm. So this is the most popular definition of firm: equity plus preference plus long-term debt plus short-term debt together. It is named as firm. So this is just the breakup of the phrase. Now I will further elaborate what is firm and what is equity and what cash flows do we need to consider and what cash flows we should ignore. So now I'm making a list of stakeholders in a company. Stakeholders means people who are interested in the business of the company. So the most interested people are equity shareholders. They are stakeholders. Then preference shareholders are also interested in the business of the company. They will have dividend income. Long-term debt providers, they will have interest income from the company. Short-term debt provider also get interest income from the company. They are also interested. They are also stakeholders. Suppliers are stakeholders. They get business from the company. They supply goods and services. Customers, they buy goods and services from the company. Employees, sometimes they are most important asset, say for a software company or consulting firm. Others, maybe landlord or maybe many other people who are connected to companies in different manners. Auditor of the company, internal auditor of the company, cost accountant involved with the company, company secretary, many people who are involved with the company. These are various people who are interested in the company. So the first question is, from whose point of view I want to calculate value? One point of view is I want to calculate value from the point of view of equity shareholders only. Other people can say, I want to calculate value from the point of view of firm. This is the red circle is firm, equity, preference, long-term debt, short-term debt. So first of all, you need to decide that from whose point of view you want to arrive at value of the firm. First, very important thing. Once you decide the circle that I am at circle 1 or I am at circle 2, choose one of the two circles. Then there are two rules of thumbs. Rule of thumb is take cash flow of people outside the circle only. It means ignore all cash flows which are generated due to people inside the circle. Suppose I want to calculate value of firm. I want to calculate value of the firm. So I'm talking circle number 2. So I'm trying to calculate free cash flow to firm. Circle 2 means I'm trying to calculate free cash flow which is available to the entire firm. So I receive money from customer by cash or credit sales, that is inflow. They're outside the circle. Money paid to suppliers for purchase of raw material, outflow. Treat this cash flow. Any remuneration paid to employees, outflow. They're outside the circle. Rent paid to landlord, audit fees paid to auditor, outflow. They're outside the circle. Treat cash flow of people outside the circle only. But interest on short-term debt, interest on long-term debt, dividend to preference share, dividend to equity shareholder, ignore all these items because they are inside the circle. You need not to consider their cash flows. Okay. Similarly, repayment of short-term, long-term debt, redemption of preference share, buyback of equity share. No, it's not a cash flow. They are inside circle number 2. We are talking circle 2. Similarly, amount received on issue of short-term or long-term debt instrument, amount received on issue of preference share, amount received on issue of equity share, ignore it. It's not a cash flow. They are inside the circle. Rule is take cash flow of people outside the circle only. But if I'm talking about circle number 1, I want to calculate value of equity. Hence, I'm interested in calculation of free cash flow which is available to equity. Available to equity means सबको बांटने के बाद जो बचा. If I'm talking circle number 1, it means preferential, long-term debt, short-term debt. They are also outside circle. So interest on long-term, short-term debt, dividend on preferential, outflow. Treat it as outflow. Repayment of long-term, short-term loan, redemption of preferential, outflow. This is also outflow of cash. Right? If I'm talking about circle number 1, take cash flow of people outside the circle only. Because those who are inside your circle, why to consider their cash flow? They are your family. So this my coat. This is my coat. So there is one left pocket, there is one right pocket. I take money from left pocket and keep it in the right pocket. And I'm sad, oh, I lost money, and I'm happy I received money. What is this nonsense? This is me, myself. So my internal cash flow, I will not consider. In fact, if you reverse this concept, it will become the philosophy of life. Say someday you're sitting alone and you're thinking, that who are my people? Mere apne log kaun hai? Apply one simple test from your point of view. If after paying money for somebody, somebody calls you and say, so I want to travel to Goa. This COVID-19 has been I'm depressed now. I want to go visit Goa, have some fun, come back, refresh, and then I'll start working. Some of your known person make a phone call to you and he says, book my air tickets, whatever, suppose airlines are working over there. Book my air tickets, book my hotel room, fully paid, modified American plan, breakfast, lunch, dinner included, and hangs the phone. And you online book air ticket for him, her, and hotel and everything, local conveyance, everything. If after paying this money, you note it down in a diary, I have paid money for this person, I have to recover it from him. Or if you note it down here, I have paid money for this person, either in cash or in kind, I have to recover money from him. He is outside your circle. Because if this ticket is booked for your spouse, for your kids, for your parents, you don't note it down, either here or here. They are inside your circle. You don't treat their cash flows. If you're treating cash flow of somebody, it means they are outside your circle. So you can apply it in a reverse manner also. Just for the sake of your memory, I said this. Okay, so this is one thing. Now, second rule of thumb. For discounting rate, take people inside the circle only. So suppose I am talking about, circle number, I'm talking about circle number 2. So who is inside the circle? Equity share, preferential, long-term debt, short-term debt. So cost of equity, cost of preference, cost of debt, all these costs should be included. So I will take a weighted average. Weighted average cost of capital is the suitable discounting rate for circle number 2. For circle number 1, who is inside the circle? Only equity share. So suitable discounting rate is cost of equity. That's simple. Ultimately, decide the circle. Outside the circle, people take their cash flow. Inside the circle, people don't take their cash flow, but consider them in discounting rate. Everybody will be considered once, either in the form of cash flows or in the form of discounting rate. Everybody will be considered once, either in the form of cash flow or in the form of discounting rate. Nobody will be considered twice. Nobody will be entirely ignored. This is the concept, sir. I will share this with you, this file also, which you are seeing right now on the screen. But still, I wish that you take a screenshot or picture of this so that when we'll be doing a question, it will be handy to refer. 3, 2, 1, click. Okay, now allow me to ask one question. Suppose I want to calculate free cash flow to equity. What about dividend on equity shares? Should I deduct it or ignore it? I want to calculate free cash flow to equity.
Ignore it, ignore it.
Rajesh is saying ignore. Rohit Dhar sir is saying ignore. Hey, come on. Everybody need to answer this. Taswinji, Rohit Bajaj sir has already answered. Yes, we'll have to ignore it because it is inside the circle. What about dividend on preference share? FCFE, free cash flow to equity.
Consider it.
Okay. Amit sir is saying consider. Harsh sir is saying consider. Yes, actually, we need to consider it. You know why? Because they're outside the circle. Circle number 1, they're outside the circle. We need to consider their cash flow. Okay, let's do one question now on this. So here I go to this circle concept. This is my proprietary concept. Even if you Google it, you will not find it anywhere. But believe me, any difficult situation in exam or any difficult situation in life, if you face, you follow this concept and your problem will be solved. Question number 5. I will do the fill in the blanks thing. If you got an opportunity to take printout of my PDF file, you can do fill in the blanks on the paper. Else you can do it on Excel or on a paper, in a plain paper or on MS Excel. Suppose this is question number 5. Question data I will give you. It is not readily available. So my revenue or sales is 2 lakh rupees. And I'm interested in calculation of both FCFF, which is the bigger circle, circle number 2, and FCFE, which is the smaller, narrower circle, circle number 1. So whether it is cash sales or it is credit sales, both sales I'll consider here. Then I'll take cash expenses. Suppose cash expenses are 70,000. When I say cash expenses, it means it excludes depreciation, amortization, impairment, loss on sale of asset, etc. But outstanding expenses will be part of it. Outstanding is not non-cash. It is just deferred cash. So cash expenses means excluding depreciation and excluding interest also. Cash expenses other than interest. Sales minus cash expenses will give me profit. This profit is before depreciation because I am taking cash expenses only. Also, this is before interest. Also, this is before income tax. And it is named as EBITDA, earning before interest, tax, depreciation, and amortization. Earning before interest, tax, depreciation, and amortization. EBITDA. Okay. Now I will deduct depreciation. I wish you note it down, these figures, either in Excel, that will be easy probably, rather than paper and pen. So sales is 2 lakh, cash expenses are 70,000, EBITDA is 1,30,000, depreciation. But I need cash flow. So why should I deduct EBITDA, this depreciation and all? You know, I need
for tax calculation.
Yes, exactly. For the purpose of income tax only, I am deducting depreciation. Therefore, this depreciation should not be as per Companies Act. This depreciation should be as per the Income Tax Act. This depreciation should be as per the Income Tax Act and not as per the Companies Act. So I deduct it and I get EBIT, earning before interest and tax, EBIT. Now the calculations so far are exactly same for FCFF and FCFE. Now the road will split. Whether you want to calculate FCFF or FCFE, in either case, EBITDA and EBIT is going to remain same. Interest on long-term borrowings. What do you say? Should I deduct it in FCFF column? Or should I deduct it in FCFE column? Or should I deduct it in both columns?
FCFE.
Okay. What do other people say? Majority of the people are saying FCFE. And that appears to be the right answer. Because for FCFF, they are inside the circle. For FCFE, they are outside the circle. So interest on long-term borrowing, I will treat it like this. That's correct. What about interest on short-term borrowings? Same. Yes, just like we treated FC long-term borrowing, short-term borrowing will also be treated in the same manner. So here I get profit before tax.
So, sir, I have a question. When we say short-term borrowings, there are overdraft, interest on overdraft, etc., is also included in this, right?
Yes, yes. So short-term borrowing will include cash credit limit, book debts limit, bank overdraft, commercial papers, up to 1 year deposit taken by the company from members or non-members.
So all kind of debt is included in your second circle.
Yes, yes, yes. This is the popular way of defining firm. Some people keep short-term debt outside circle number 2. Some people. So they have their own way of defining firm, but in market, most of the people are including short-term debt in the definition of firm. So now PBT has a difference of 20,000 rupees. Can you reconcile why this PBT is 1,10,000, this PBT is 90,000? Can I get a voice reply? Profit before tax, 1,10,000 and 90,000.
Interest is tax deductible.
90,000. 90.
Yes, the difference is due to the amount of interest. Difference is due to amount of interest, right? Fine. Okay. Now, the next thing is I will deduct income tax. So under FCFF column, 1,10,000 into 30% gives me 33,000. And here it is 90,000 into 30% gives me 27,000. When I deduct income tax, I'll get profit after tax. Now the profit after tax is 77,000 and 63,000. Just check that figure.
बट सर टैक्स कैलकुलेट करते टाइम तो हमको ये हटाना होगा ना, मतलब ये जो इंटरेस्ट है फॉर द टैक्स कैलकुलेशन वी शुड.
Right. I was waiting for this question. Now look here. Now you can say that this 33,000 is actually wrong because here we are not getting tax benefit on interest. So 20,000 is your amount of interest and 30% tax benefit on 20,000 will be 6,000. So ye 33,000 is wrong because here you are not considering tax benefit on interest while actually you will receive tax benefit on interest. So we are charging higher tax in this FCFF column. If you are charging higher tax, then your cash flow will be lower. If your cash flow is lower, then your value will also be lower. So ultimately this is leading to undervaluation under FCFF column. But actually this tax benefit on interest will be considered not in the form of amount, but in the form of discounting rate. Once you calculate FCFF, then it will be discounted with WACC, weighted average cost of capital, right? And weighted average cost of capital includes cost of debt. And to calculate cost of debt, you do interest rate multiplied by 1 minus tax rate. So your cost of debt is actually reduced. So if cost of debt is reduced, WACC is also reduced. And if you discount cash flows at a lower rate, value will be automatically higher. If you discount cash flows, if you calculate present value of cash flows at a lower rate, value will be automatically higher. So that way, tax benefit on interest will be considered in the form of rate. If you consider it here also, then it will be double counting of the same benefit. And that's why this 33,000 is the correct figure, right? Now there is a difference of 14,000 rupees in profit after tax for FCFF column and for FCFE column. Why there is a difference of 14,000?
Interest part only.
But interest is 20,000.
Net of tax.
Okay, so Rajesh answer is saying this difference is after tax interest cost. What do other people say? Amit sir is also saying tax on interest. RG is also saying same. Hey, come on everybody, I need opinion of each one of you. Why there is a difference of 14,000 rupees in profit after tax in FCFF and FCFE column? It is after tax interest cost. Yes, exactly. 20,000 is interest multiplied by 1 minus tax rate. So 20,000 into 0.7. 20,000 into 0.7 will give you 14,000. Okay. That is the reason for difference. The next thing is now I deducted depreciation only for considering tax benefit. Now I have already considered tax benefit. So I'll add back depreciation now. 20,000 rupees depreciation I'll add back. So that way I'll get cash profit. This was net profit. Once I add back depreciation, I will get cash profit. And that cash profit is 97,000 and 83,000. So difference is again 14,000. And you know why 14,000? It is after tax interest cost. 20,000 into 0.7. Why FCFE column is showing profit lower by 14,000? Because here you have deducted 20,000 and thereafter you deducted tax. So indirectly you consider tax benefit on 20,000. So effectively you have deducted only 14,000 in FCFE column. Effectively you have deducted only 14,000 in FCFE column. And that's why there is a difference of 14,000 rupees. Okay, now let's talk about some other cash flows like which are not part of P&L. All these cash flows are part of P&L. No? In P&L, you consider all these things directly, indirectly, somewhere, sales, cash expenses, depreciation, interest, tax. So this was P&L so far. This was P&L so far. Now let's talk about balance sheet also. So suppose there is repayment of debt, both long-term and short-term, LTST. What should I do? Repayment of debt, it is an outflow of cash. Should I deduct it in FCFF column or in FCFE column or in both columns? Amit sir is saying only in FCFF. Try to recall that circle concept. I hope you have taken picture of that circle concept. FCFF only or FCFE or both? See, I'm talking about, yes, sir.
I believe none.
Okay. See, I'm talking about repayment of debt. So it may be either long-term or short-term debt. If I'm talking about FCFF, it means circle number 2. So for circle number 2, they are inside the circle. So their cash flow should not be treated. So for FCFF, repayment of debt should not be considered. But for FCFE, we are talking about circle number 1. If you're talking about circle number 1, in that case, this debt is outside the circle and take cash flow of people outside the circle only. So they are outside the circle, their cash flow should be considered. Only for FCFE, it should be deducted. You know, otherwise also you think for the firm, 200 rupees was available. Out of that, 50 rupees is paid to debenture holder ki tumhara paisa le jao. Now for equity, 150 is left. If for all of us, Vijayji says, I'm giving all of us, all of you people 50,000 rupees. So for us, it is 50,000 rupees. And if I pay 20,000 rupees among all of you, then 30,000 is left for me. It's like that. So all of us, less paid to debenture holder, etc., is for me. Right, sir? I hope it's clear. Only in FCFE column. Then dividend on preference shares. Just think in the same manner and tell me where should I deduct it? FCFF or FCFE or both? Yes, it is FCFE only. Okay, tell me one thing, rather than repayment of debt, if it is new borrowing, I'm receiving money, what should I do then? See, here I am deducting repayment of debt. Yes, Rohit sir. Then I'll be adding it. Then I'll not be deducting it. Then I'll be adding it. Right? Okay. Now, cash flow to the firm, after considering these two items, 97,000 remains 97,000, but 83,000 becomes 77,000. Now this cash flow, 97 and 77, there is a difference of 20,000 rupees. You know why there is a difference of 20,000 rupees? 14,000 is after tax interest cost, plus 6,000 is 5 plus 1, 6. Why difference of 20,000? 14,000 is interest cost, 5,000 is repayment of debt, 1,000 is preference dividend. These differences due to only these three figures. I'm sorry. Okay, let me do one thing. This difference is why there is a just a minute. Why there is a difference? Difference is due to three reasons. One is preference shareholder, other one is long-term debt, and the third one is short-term debt. Okay. Now, I want free cash flow. So free cash flow means whatever I earn, a part of it will be reinvested in the business itself. I want free cash flow. So for free cash flow, I have to consider capex and increase in working capital. So tell me, increase in fixed assets. Should I deduct in FCFF? Should I deduct it in FCFF or FCFE or both? Yes, because I want free cash flow to firm and free cash flow to equity. Free prefix is there in both columns. Similarly, increase in working capital. It should also be deducted in both columns. But when I say working capital, current liabilities, Rohit sir, now your question. Current liabilities should exclude short-term borrowings, cash credit, book debts, bank overdraft, etc. What is working? So, here I am taking change in working capital. So one working capital increased from 1 lakh to 1,15,000. That's why I'm showing outflow of 15,000. But how do I calculate working capital at a point of time? It is current asset minus current liability. But here in this table, in working capital, under current liabilities, I should exclude short-term debt because short-term debt has already been treated. If you include it in current liability also, it will be double counting. Exclude short-term debt from current liabilities. Usually it is included in current liability under balance sheet, but short-term debt should not form part of current, should not be part of current liability. It has already been treated. So in working capital, don't include it. And one more thing, in current assets, do not include cash. Sir, why should I not include cash? Because cash is the item we want to calculate. That what is the amount which is freely available for distribution to investors. That is what we want to calculate, and that's why cash should be excluded from current asset. This is the internationally popular belief that cash should not be included in current assets in this calculation. I personally have a different belief. So in examination, follow what is believed internationally. But my logic, you can consider that also, not in exam, but in your assignments. Current asset should include regular cash, but should exclude surplus cash. say I am a software company, my salary bill is 1000 crore rupees per month. I have a policy to keep cash and cash equivalents in the company equal to 3 months salary. So accordingly, my regular cash balance is 3000 crore rupees. If I am maintaining cash over and above 3000 crore rupees, that is surplus cash. What I am saying is regular cash should form part of working capital. Exam में मत करिए ऐसा, but logic समझ लीजिए. So suppose earlier my salary was 1000 crore per month. So my regular cash required blocked in the business was 3000 crore. Now my salary bill has gone up to 1500 crore rupees per month. Size of the company is increased. So what does it mean? Now I'll have to maintain cash equal to 4500 crore rupees. So earlier my cash balance was 3000 crore. Now it has gone up to 4500 crores. So extra 1500 crore rupees is blocked in the business. This cash is not freely available that one day if I decide I want to distribute huge dividends or distribute this amount also. No, I cannot take it out from the business. I won't be able to run my business. So this 1500 crore rupees extra regular cash, if I'm investing, that should be treated as an outflow of cash to arrive at free cash flow. But popular belief is do not take any cash in current asset. Do not take any debt in current liability. This is how you calculate working capital. And finally, you arrive at free cash flow to firm or free cash flow to equity. So 97,000 you earned, 40,000 you reinvested, you are left with 57,000. Here 77,000 you earned, 40,000 you reinvested, you are left with 37,000. Difference between the two is 20,000 rupees. Difference between the two is 20,000 rupees. And this is due to 14,000 after tax interest cost. And two things are there, say 5,000 interest, repayment of debt, and 1,000 dividend on preference shares. So any question before I move ahead? Any question on this? If not, then I will need just 3-4 minutes of your... Yeah, please.
If we're talking about for the fresh borrowings,
yes,
in terms, so we are just including in the cash flow available to the equity shareholders. So don't you think we should ignore that part?
Suppose this year I borrow 1 crore rupees, whether it is short-term or long-term debt. So it should not be, that should be excluded while calculating FCFF. FCFF, we will ignore this inflow of 1 crore rupees. And for FCFE, we will consider this inflow of 1 crore rupees.
That is my query. As a conservative approach, don't you think we should ignore it?
In FCFE also?
Yes.
No, sir. Here is the concept. Look, if you want to calculate free cash flow to equity, that is to me, myself only, no other person. Right? Suppose I am running a business or a profession I have. So my annual revenue is say 25 lakh rupees and 5 lakh rupees I pay salary to staff, etc. So 20 lakh rupees per annum is the amount which is available to my family. Now, after spending money on my spouse, children, parents, whatever is left is for me. So when I was calculating family income, I was not deducting school fees of kids. But when I was calculating my personal saving, then I will deduct the school fees of kids also. So similarly, here this loan, it is inside circle number 2. So we ignore it here, but it is outside circle number 1. So we consider it here. Because if I'm borrowing, that amount is not now available to equity shareholders. No, I'm not distributing dividend out of it. But, technically, legally, you can even borrow money to pay dividend. Say liability side of your balance sheet, you can see huge reserves, but asset side, you don't have cash because every single rupee of cash is invested. So even you can borrow money to pay dividend. So if you're borrowing money, that money can be made available to equity shareholders in the form of buyback of share or in the form of dividend to equity shareholders.
And even for business expansion.
Sorry?
Even for business expansion also.
Yes, yes. That money can be used for business expansion also. Yes, you are right. So now I need 3-4 minutes of your time. I have pasted one link here in the chat window. And that link is a feedback cum networking form. This time I got, due to some, Vijayji was busy, so schedule was not prepared well in advance. So I'm giving just 4 hours time here. So I don't got an opportunity to interact more with you. Still, I'm asking for one, this, RVO will take its own feedback, but it's my practice to take my own feedback also. This is the link to feedback form. Please click it and fill it up. Here I'm asking about your personal details also, like where do you practice, what is your area of practice or job, etc. So even once you become a registered valuer, so tomorrow maybe we two can synergize together. I'm not doing many type of work and I get some work, I can pass it on to you and vice versa, or we can perform something jointly. So just fill up this feedback cum networking form. And meanwhile, I'm just waiting for you for next 5 minutes. Just request everybody to do it now because there is no tomorrow, there is no evening. You all are very busy professionals, I understand. This time I have got just 4 hours of time over here. So even I am feeling short of time. Otherwise, we would have gone much into depth and breadth. But don't worry, if I am not here, the other faculties will cover that concepts. It's not like that you will lose on the concept side. You will be getting each single concept. Don't worry. But yes, I am not in a position to deliver more because we are out of time now. Okay, still allow me just for one simple concept to include discount for lack of control and discount for lack of marketability. So it's here. discount for lack of control, and discount for lack of marketability. You know, especially when you are using the market multiple approach. What is this? You calculate FCFF, FCFE, then you use weighted average cost of capital or cost of equity. Then you arrive at the value of the firm or value of the equity. You arrive at value of equity or value of the firm. Thereafter, what next? Once you arrive at value of equity or value of firm, then you need to adjust some discount or premium for control and for marketability. What is this? Let me give you one example. Suppose I am using market multiple approach. You must be aware about a very popular ratio which is named as price to earning ratio. Yes, we are running out of time. 1:45 up to it was scheduled, but give me some little extra time. Maybe your next, when do you have the next session? At what time will it start?
Around 3.
Okay, then it's fine. Then it's fine. So I can take 5-7 minutes more and then I'll wrap up the session. So you'll have at least 1 hour of lunch break in that case. So I was telling you one thing. My company is unlisted. I'm trying to make valuation of my company. I found a comparable listed company. Then I calculate price to earning ratio of comparable listed company. Price earning ratio, market price per share divided by earning per share. Suppose price to earning ratio of the comparable listed company is 20 times. Price to earning ratio of comparable listed company is 20 times. Now my earning per share is 10 rupees. So what do? 10 rupees multiplied by 20 times. 10 rupees multiplied by 20 times give me 200 rupees. I'll type it here. So EPS multiplied by, I'm typing it in the chat window. P ratio is equal to MPS. So my EPS is rupees 10 multiplied by comparable listed company has 20 times price earning ratio. So my fair value should be 200 rupees. But now there is a problem. And the problem is that company from which I am borrowing this P ratio is listed company. So investors over there get liquidity. They can quickly sell their share whenever they want. But I am going to invest in unlisted company. I'll be stuck over here. It is difficult to find a party who will buy my shares in this company. So I don't get any liquidity. Now that's a big problem. Suppose you make fixed deposit in a bank for 50 years and bank says that they will pay interest also after 50 years. And meanwhile, neither you can break the FD nor you can take any loan against it. Now that's the difficult situation. Liquidity is something which is very important for investors. That company has liquidity. My company doesn't have liquidity. So their P ratio of 20 times, I'm applying it as it is on my price, but I don't deserve 200 rupees of market price in that case. Suppose I say, so usually people deduct 20 to 30% discount. In chat window, I have typed. I'll say discount for lack of marketability is 25%. So 200 minus 25% is equal to 150 rupees should be my price. But don't make it a habit that whenever you get valuation assignment and you are making valuation, then always deduct discount for lack of marketability. No. Now take a different example. I am unlisted company. I found a comparable unlisted company. That unlisted company has recently got a round of funding from venture capital. And that round of funding is 4 times their book value per share. So book value per share of equity share of comparable unlisted company is 100 rupees. And they allotted share to one venture capital investor at 400 rupees per share. So 4 times their book value, their share is recently transacted in a private deal. And those private deals are always reported in newspapers and many other places. So their price to book value ratio is 4 times. My book value is 50 rupees multiplied by 4 times. So 50 into 4 times 200 rupees is my fair value. Now I will not deduct discount for lack of marketability because the comparable company is also unlisted. My company is also unlisted. We are at par. I need not to make any adjustment for it. Right, sir? This is discount for lack of marketability. Now discount for lack of control, or the opposite word will be control premium. You calculated free cash flow to equity. You know, free cash flow to equity means you are assuming whole company is yours. Whatever is available in the company, it will come into your pocket. You are assuming. As in when you calculate FCFF, FCFE, you are assuming that the whole company is in your control. Because cash flow of company is not cash flow of investor. But if you are assuming that it is my cash flow, then it means you are talking about majority stake in the company. FCFE discounted with cost of equity gives you fair value of entire equity of the company equal to 100 crore rupees. It includes control element because you are taking entire company's cash flow. So 100 crore rupees is fair value of equity shares multiplied by 1 crore shares in the company. So the fair value per equity share is 100 rupees. That is when I acquire whole company. But I am going to acquire only 9.9% stake in the company, like Facebook acquired in Reliance Jio. So I won't have the control. This price, which I have calculated, it includes the element of control also. 100 rupees minus discount for lack of control 20%, I will pay only 80 rupees. Because with 9.9% shares, I will not have control over the company, while the value I have calculated includes the control premium. And how do you know that it includes control premium? Because you have calculated value of company using free cash flow to equity. That is, cash flows are under your control. You are assuming. And now you want to acquire only minority stake. So deduct discount for lack of control. Reverse thing is also true. Sometimes you add control premium. Let me give you last example for this and then I'll close the session. Say again, same example. My company is unlisted. Comparable company is listed. They have P ratio of 20 times. My earning is 10 rupees. So 10 rupees into 20 times. My fair value is 200 as per P ratio. P ratio of comparable company is 20 times. And how did I calculate their P ratio? Market price per share upon earning per share. How come market price per share? Okay, answer my one question. Say 75% shares in a company are with promoters. 25% shares in the company are with public. So whatever market price you are seeing, is it the market price which is due to buying and selling of share by minority shareholders or buying and selling of shares by majority shareholders? Should I repeat the question? You say ABC Limited is currently quoted at rupees 700 per share. How come 700? Because people are buying, selling share at 700 at NSE BSE. Who is selling, buying share? Promoters or minority people?
Minority people.
Minority people are trading. So this 700 rupees per share price is when you are acquiring minority stake in the company. 100 shares in the company which has 100 crore shares. And that's why this P ratio excludes control premium. So their P ratio is 20 times. My earning is 10 rupees. 10 rupees into 20 times is 200 rupees my fair value. But this 200 rupees is just to acquire minority interest in a company. But in this unlisted company, I'm going to acquire 70% shares, 100% shares. So I need to add control premium. So there are two things. One is control over the company. Another one is liquidity, exit from the company. So either it is discount for lack of control or the opposite adjustment is control premium. And similarly, either it is discount for lack of marketability or it is marketability premium. So you need to make these adjustments if it is at all required. Right, sir? And last one thing is here. I know I'm already out of time, but look here. The formula is, if premium rate is given, you can calculate discount like this. Premium upon 1 plus premium gives you discount. So if premium is 25%, so 0.25 upon 1 plus 0.25 gives you 20% discount. Try to recall cost sheet. If you have ever studied cost accounting in your syllabus, 25% of cost is 20% on sales. Are you able to recall something like this? You prepare a cost sheet, cost of sales is 100 plus 25% profit you add. So 125 becomes the sales. But sales minus 25% don't give you cost. Sales minus 20% gives you cost. So it is that shortcut formula. And they ask 1 mark MCQ in question. Yes. And similarly, premium, if you want to calculate, it is discount upon 1 minus discount. Right, sir? So in the short amount of time, I have tried to cover as much as possible. If you felt that something you are not able to grasp it, then feel free to connect to me for asking any doubts in future. My contact number is already with you in the PDF file. Thank you for your patience for continuously 4 hours and wish you all the best. Now you can have your lunch break. All right then.
Thank you, sir. Thank you very much.
Most welcome.
Purani yadein taza ho gayi, sir. After 12 years.
Right, long time.
I was like very excited from since yesterday evening.
Okay.
Thank you, sir.
Most welcome. Even I enjoyed the session. All right. Bye-bye. I'm taking your leave. Bye. Yes, 3. I don't know. You people are saying that 3 p.m. is your session. You can cross-check it with time with Vijayji, or you can communicate him that we are free now, so we'll start at 3, so that they can communicate next faculty accordingly.
Rohit sir. Hello. Rohit sir. I think we should convey to Vijay sir or Anvata madam for completion of the.
I'll call up Vijay sir on the phone.
Fine, sir. Fine. Thank you. We are disconnecting now.